Hey, good evening, folks. Welcome wherever you're listening in from. My name is Kalu, and this is my Money Spaces on X. And here we're, of course, talking the economy, finance, i.e., personal finance, and of course, anything investing, right? That's what we do here every Sunday, 7 p.m. West African time. This week we have, should we say, this is going to go the special edition. We're talking about retirement and saving schemes that we have in Nigeria, the US, and Canada. We can talk about any. I'm not that conversant with the UK retirement scheme. So help me out if you have that knowledge. If I drop the American one or the Nigerian one, you can drop the UK one either on the chat or just by asking a question, right? But one just work our way through how someone that is trying to say migrate or emigrate to say Canada, how should you set up your pension scheme over there? What are the key things you look out for? What are the differences with say the 401k and the IRA? What do they mean? And of course, we're doing this because there are a lot of Nigerians that are now living abroad and they have got to, should we say, change their investing mindset to sort of match what they find when they are abroad. That's exactly one reason why we are doing this. I think it's very important. We do get lots of comments and questions about should I open up this account or what is an IRA? How does it help me and all that? Hence, we're doing this. So feel free to jump in, ask a question and all that. It's going to be more of me answering questions, but let me give you my take, right? Just the differences between the RSA, which is the retirement savings account. That's Nigeria. So Nigerians have got their retirement savings account, the RSA. The Americans mostly have what's called a 401k, which is just the law, the name of the law that created their retirement schemes. And of course, the Canadians have what they call the Registered Retirement Savings Plan, the RRSP. But they are all the same. They are all tax advantaged ways to save. What that means is that when you make a contribution from your paycheck to this, should we say, schemes, that distribution is tax advantage. If you do a distribution from your paycheck to your 401k, you can claim a tax relief on that contribution. That's one. So your contribution is tax exempt from, so you don't pay taxes if you make that contribution. So that's both on the retirement savings account, on the 401k, and of course the RRSP from the Canadians. Also, when those funds then grow, you put the money into those schemes and they are growing, i.e., they are being invested by your managers and are growing. The growth is also exempt from taxes, right? So when the funds are growing, they are exempt, which is a big advantage. I think the key advantage why you want to have a retirement account as different from an investment account. When you pay an investment account and you make growth, right? In the US, you might pay capital gains taxes if you sell. If you also sell on your private investment account, you also pay taxes. But with the pension funds, i.e., with the pension schemes, all that growth is tax exempt, which means you're not going to pay taxes on the growth or appreciation of those assets that you have parked into your 401k or your RRSP or your retirement savings account, which is the Nigerian, Canadian, and US ones. So that's a big advantage for that your growth can basically expand. You can compound your returns without worrying about taxes. So you're not disturbing the compounding, and it's just going forward. What of when you withdraw the funds? Like same thing, right? If you have a 401k and you take out those funds, then that's income. 401k is the American side, right? That's income to you, right? So if you then take that income, you will then be assessed if that raises your income, your tax brackets, right? And then you might pay taxes on that because when you take it out, then it becomes income to you. Then that's when you pay. The Nigerian system as well. Same thing, is tax deferred. When you take it out, you still have to pay taxes on it if you are taking out, say, the gratuity part of your retirement savings account, right? But the usual monthly pension that you take out, I think that has got some tax protections. I believe. If I'm wrong, please someone should correct me. I believe you still get some tax protections on that. For the Canadians, I think they do enjoy, number one, carry forward rules, which means that if you don't contribute, let's say you were to have contributed at a lower tax benefit, as a lower tax earnings, and you did not contribute, you can actually carry over your unused contributions to when you are at a higher tax bracket and still make contributions to your account without then paying those higher taxes. So they have a carry forward rules that allow you to maximize and take advantage of all your contribution levels, even when you did not contribute at a lower tax level. And of course, the RRSP, the Canadian one, doesn't penalize you if you take out your money before retirement, but you will pay taxes on that early retirement. The 401k will penalize you, i.e., the American system, if you take out funds before you get to the age of 59 and a half. The Nigerian version really has no retirement age. That's a good thing about Nigerian version. There is no retirement age per se. If you basically are retired, right? If you say you are retired or before you hit the age of 50, then you can take your funds out. They're not going to penalize you as long as you are no longer employed. If you get out of a job before, say, 6 months and you are out of the job, you can apply for 25% of the funds in the Nigerian pension scheme. But when you retire per se, when you say you are no longer employed, you no longer have a salary coming to your account, you can apply to get the full benefit of your pension scheme. But the key thing is that all these rules, and you guys can Google them and basically find out the nuts and bolts. The key thing is this. Nigeria, we just started the Pension Reform Act in 2004, 2005. So we're pretty young in this retirement savings scheme. Most young folks today, if you don't work for a large corporation, you don't work for the government, you might get through employment in Nigeria without contributing to a pension scheme. And that's usually normal. I believe even though we have close to $1 trillion in asset under management in Nigerian pension scheme, the contributors are still the formal private sector, the government workers. You don't have a lot of informal contributors. So when we go over to the West, right, we don't understand the benefits of contributing to a pension scheme. And that's basically what this space is trying to talk about. Once you are in the West, right, and you are earning an income, you must try to contribute because you get a tax advantage once you contribute. So I'm going to give you how you want to do it step by step. And if you can write this down, that would help you, right? So if you live in the US or if you live in Nigeria, right, US or Nigeria, that's what we call the individual retirement account, the IRA in the US. And in Nigeria, we have the additional voluntary contribution. This basically means in the US, you can set up your own pension scheme. That's the IRA. So with the IRA in the US, you can essentially say you'd like to contribute into a fund, into your own pension. You make your own contributions to a fund separate from what your employer is doing. Now, this fund there are two types of IRAs. There's the Roth, ROTH, the Roth IRA, and there's the traditional IRA. This is the US. When you contribute to the Roth, the ROTH IRA, you pay taxes when you contribute, which means if you earn $100 and you contribute $10 to your IRA, you do not have any tax benefits when you contribute. You will still be taxed on $100. But once you are taxed, you don't pay taxes anymore on your IRA, your Roth IRA. So if you contribute into an IRA whilst you are still younger and are earning less and you pay your taxes at the lower tax bracket. When you get older and you earn more and probably you're the higher tax bracket, you can take out your money without paying taxes and without any restrictions on age, as long as the money has stayed more than 5 years. So for the US, you've got the IRA, like I said, two types, the Roth and the traditional. You want to do the Roth, especially if you are younger, the ROTH. That plan is so good that the US government will stop you from putting too much money into it. I believe for this year, the Roth is only $6,500 you are allowed to put into your Roth IRA. So it's that good, essentially, that the US government will not allow you to put more than $6,500. So when you want to invest, right, the very first thing, ask your employer, do you guys offer a 401k? That's if you're in the US, 401k. If you're in Canada, the RRSPF, right? Just basically ask them, is there a retirement savings scheme in the organization? If they say yes, your next question is, what is the match? What is the match? In Nigeria, the match is for every 10% that you contribute. So for every 8% you contribute, your employer contributes 10% of your basic housing and transport. So you get a total of 18% if you're living in Nigeria going into your retirement savings account. All you have to do is contribute 8% and your employer contributes 10%. So very generous if you're in Nigeria. If you're in Nigeria, you must, and you work for an employer, you must contribute, because that's 10% salary increase right there. If you don't do an RSA, you are missing out on 10% salary increase, because that's money that the employer must contribute irrespective of your income. So that's Nigeria, 18%. You contribute 8, your employer matches it with 10. So you must do that in Nigeria. In the US, you want to ask what the 401k match is. If they tell you we match you 4%, then you must do minimum 4%, which means that for every 4% that you do, your employer is going to match you 4%. You want to make sure you are matching. You don't leave money on the table. If your employer matches 10%, you contribute 10%. Lock it in. Because it's free money, right? You contribute, your employer contributes, it goes to your 401k, which is in your name, then it's invested. So why leave it on the table? If they're matching you 5, you match minimum 5. Very, very important, right? Same thing with the Canadians. Ask them for their matching, the RRSP. They're matching 5 to 5 minimum. So that's what you want to do. The first thing you do is you want to find out if your company have a pension scheme, and then you want to contribute the minimum of the match, because you want to maximize that match. Number 2 is then you do your IRA. So after you've done your company match, because it's free money, you then want to invest on your own. And this is for Nigerians, right? If you notice what you contribute, the 18% may not fund your pension. How do you know this, right? If you want to take your pension, you want to take, rule of thumb, 50% of what you earn now is what you're going to be spending when you retire. So your expenses reduce and your income reduces when you retire. So you want to do a calculation and say, how much money do I need in bulk sum when I retire to pay me at least 50% of my salary? And any banker, any accountant can do this calculation for you. They basically say, if I need 25 million, how much do I need to save every month so I get 25 million in, say, 10 years? They'll do that calculation for you. Now ask yourself, is the 18% going to hit that minimum? I need to make that X amount bulk sum when I retire. If the answer is no, then you want to do your additional voluntary contribution to match that. Exact same thing you're doing in America. If your contribution, your total amount that you want to have when you retire, is not going to be paid by the 401k, then your IRA is how you want to do a catch-up. So you do your additional voluntary contribution for Nigeria, But in America, you do your individual retirement savings account, your IRA. You can do a Roth or you can do a traditional. I prefer the Roth for you because when you are contributing as a younger person, you are contributing at a lower tax, or you are paying taxes when you contribute. But when you take it out, you don't pay any taxes. So that is perfect for you because you then would have gotten a higher pay rise, so your taxes would be lower. Does that make sense, guys? So number one, do your contribution, you make sure it is matched. Number two, you then do your individual retirement account, which you can do a Roth, I prefer, or a traditional. So all those other schemes have got their own, like I said, individual this or individual that, but this is how you want to do it. This is for pensions, guys. So I'm going to stop here, take a few questions on pensions. We're going to try to do also how you can invest when you're going from Nigeria, of course, to the West, how you can set up your own investment plan because it's a bit different over there. And also, if we have enough time, also do credit and of course, how you can even get a mortgage. So let's take Ken. Ken, I've got you on the line. Ken, what's up, man? Thanks for holding on. I try to a lot of info, trying to make it sound, should we say, a bit streamlined. Ken, you've got the floor. You got a question for me, sir, before I go to DM?
Yeah,
Hey, Ken.
thanks a lot, Carlo. Thanks again for the opportunity. Good evening, everyone. Congratulations to Nigeria for qualifying for the AFCON, top of the group. So a quick question around, by the way, the topic today is very good. There's a lot to learn, actually. Always a lot to learn when we are in your space. The quick question I would like to ask, you mentioned the Nigerian RSA.
Yeah.
That once you are, I think before you can actually get that lump sum, the gratuity, I think the law states you must have done at a minimum of 10 years in service. So what I would like to ask is, let's say you've done that 10 years, or maybe you have retired at 60, as mandated by the law of the land. What happens to the other 75%? Are you able to get them as a lump sum, or at that monthly payment? How is it distributed? Do they do like a life expectancy for you and then spread it over that period of time? Just a curiosity on my side, if maybe you have the answer to it.
Yeah,
Thanks.
so the way they've done it now is that the old scheme is completely gone. They don't have any gratuity like anymore. What they have now is if the company wants to pay you a gratuity, that is fine. They can pay you and they can have their own way of paying you, not a problem. But what they've done now is what they call a contributory pension. So contributory means that the contributions are what are defined, but the benefits are not defined. So essentially in Nigeria, once you start to work, there is technically no mandate for your employer to give you a gratuity, but your employer has got to pay you 10% of your basic housing and transport. That's what the law says. So that's the minimum they have to pay. Your employer can pay the entire 18%, but it has got to pay the minimum of the 10% of your basic housing and transport. Now, what then happens is that when you then retire, if you say you are retired, you then have two ways to get your funds. You can take 50%, right? 50% of the total bulk amount as lump sum payment. That can come out to you 50% max. Or I think they want to update that. Then the other balance is what you then take either as an annuity. So you go to an insurance company and you buy an annuity to 50%, or the PFA can also give what's called a program withdrawal. And essentially is that they pay you the balance of that bulk amount over the lifetime of your lifetime, more or less. That's what they basically do. So no more gratuity. They can do that if they want to, but no longer mandated by law. It's just going to be your contributions. And then when your employers contribute, they also have a life policy on you. In case anything happens, they can then pay that to you. And when you retire, you then get the bulk sum plus the, an annuity that you have bought. Now they have included what we say. You can use a part of that to also do a mortgage, which is very very good. So you can do a 25% mortgage. You can do the rest. Will then go 50% to bulk sum and 50% to the annuity. Hope that answers your question, sir.
Yeah. Thanks a lot. So eventually, that means maybe at the point of death of that person, the outstanding, I would say, of that annuity, does it automatically go back to the government, or there's a way that can be transferred to the next of kin?
Great question.
How is that done?
Great question, and it depends on what type of annuity that you buy. What annuity do you buy? So look at it this way, right? You can go to an insurance company and buy what's called a life annuity, meaning that for the rest of your life they pay you. You can also buy an annuity with a survivor benefit, which essentially says that if you pass on, you want annuity to go to this person, right? You can also buy an annuity that has a life setting, which means if something happens to you, it goes to this person and they will pay that person for this particular amount of time. When you buy the annuity, it's customizable with the insurance company. It's your money, but when you say the life policy, which is the money comes to you alone, you get more. If you say you want a life policy that is going to be shared to a beneficiary, you get less because the insurance company will pay you, then pay your employer, your beneficiary as well. With the PFA, same thing. You can say pay me, and you can actually say pay to my trustee or pay to myself, and it goes into an account, and that account is then set up to a trustee. So all these things are customized, which is the point I'm trying to educate, that you have got to think about where you want that money to go to. You just can't leave it to what they say. So if you, for instance, have got young kids, you can say to your PFA, I want you to pay it to this corporate trustee. You can select, say, just off my head, First Trustees. And First Trustees becomes your beneficiary. And your pension is paid to First Trustees. And First Trustees can then go and say, you can tell with the trustees, hey, this money should go to the education of my 3 children. And if after my 3 children are allocated, I keep the balance to my church or to my community or whatever. So you just can't look at this money as pension. Because you're given the leeway to use it, right? Then you have to then, sort of like use those monies and do what you want to do with it. I see lots of people saying, I want to get my money, it's my money, I want to get it when I'm for 55. Yeah, again, you can do it that way. You can go to your bank and write an agreement. It's not allowed in law. You're not allowed to use pension as collateral. But if you go to an organization and you say, I have 10 million in my RSA, and when I retire, this 10 million is going to be paid to me every month. But I want to buy a house today. I'm going to sign an agreement to say these funds must be paid to you. Nothing's wrong with that, right? And that's what the pension fund guys have tried to kickstart by still allowing you to do 25% of this. So I would say, get someone to advise you properly, and then try to tie the pension retirement account into your own budget, into your own objective. For many Nigerians, it's the only secured, sure, and guaranteed payment that they're going to get from Nigeria. It's not managed by the government. It's managed by the private sector, which is why it hasn't failed. This is a totally private sector arrangement. The government's job is just to regulate, and they also contribute. So that's why really it has stayed. Yeah. Mm-hmm.
Great response. Thanks a lot.
All right, super. And I've got, of course, my DM folks have all jumped in. So let me take a look at this one. I want you to explain again what did it say? The transfer. What did you mean by the transfer of the Canadian catch up, right? Yes. The Canadian carry forward rule. So I want you to explain the RRSP carry forward rule. What it means is this, right? In the US, you have to contribute your 401k for say annually. So for 2021, you contribute X amount, and that's it. If you don't contribute for that year, you lose it, right? So you have an allowable maximum contribution for the year. If you don't contribute, you've lost it. Same thing with Nigeria. You have to contribute your basic housing and transport for that year. If you don't contribute, it sort of goes away, and even your 25% maximum voluntary contribution also is capped. But with the Canadians, you can carry forward a portion of that unused allowance. So in Canada, if you don't contribute, say in the year 2021, what you didn't contribute is an unused allowance, which you can then use to contribute more in later years. So let's say you get a job today and you're earning a very, very low income, and then you get a job tomorrow or in 5 years' time paying you a higher income. You can still contribute in Canada using your unused contribution, which will now be tax protected. Just a way for you to avoid paying taxes, because you can contribute more income to your current retirement savings account using past unused contributions before you can then start to contribute using today's income, which will be taxed higher. Hope that makes sense. So if you don't use it last year, you can carry it forward and you can contribute that last year's contribution into this year, especially if you're going to a higher tax bracket, and that gives you a big advantage. That's what that carry forward rules for the Canadian ones mean. Hey, Labi, how are you doing, sir?
Thanks, Kalu. Thanks for this topic. So I kind of have a personal situation as regards to this topic. So I'll start with my experience when I was in Nigeria. I was operating this pension contribution scheme. And what I realized is the flexibility at which this scheme is being run compared to where I'm currently in Canada. So in Canada, you can have as many RRSP with all institutions as much as you want. I mean, you are looking at it from a risk and return perspective. I mean, they invest, you see how much they make annually. So there is competitiveness. You can move your funds around. But in Nigeria, I think you are just only tied to a PFA to put your funds, and which I think, I mean, if you look at it over the years, the returns on those investments are not really encouraging. So just also let me compare. I do a personal, investments myself, and I can say that the money I took out of my 25% compared to what is currently sitting with my PFA, the return I have, I mean, there was a COVID in 2020 when the stock markets, provided a great opportunity for people to invest. So I've made so much, running a personal, investment compared to putting my money in this PFA. So overall, I would just say, I mean, if there is more flexibility as regards to how you can, move your funds around across all PFAs in Nigeria, it really encourage people to, do this personal contribution scheme.
And let me ask a question. So you're saying in Canada it's possible to have, say, RSAs with, say, 3 different companies but the same RSA. Is that what you're saying?
Yeah, RRSP. So there is RRSP, there's TFSA. So what the government do with TFSA is there is a max of 6,500, which, as you said earlier, you can carry forward. But you can have with various banks. You can have with maybe, let's say, Zenith, Wema. But at the end of the day, as long as you've not, overshoot the $6,500 Canadian dollars, you are still good to go. So it helps you look at which fund manager is kind of giving a good yield on your investments, and you can play around with them. But in Nigeria, you don't have that flexibility, and I mean it's kind of discouraging to put in some additional voluntary contribution into the scheme.
I agree. I think it's good information on the Canadian scheme. The Nigerian scheme, I think for now, what they've done with the RSAs is you can do a transfer. So you can go from PFA to PFA. So that's one part of it that they've allowed to do transfer of PFA. But I think you're right in terms of one thing that the Nigerians have not done is to allow the contributors choose where they should invest the monies. So we have 4 funds right now. When we started in 2005, 2004, we had just one fund. So if you open up an RSA account in Nigeria, that's a retirement savings account in Nigeria, you only had one option. And that option was heavy into bonds, which meant that if you were a younger person in Nigeria, you are more or less not taking advantage of the capital market, the stock market, more or less. Now they have four funds. So it's three funds plus one retiree fund. And they've tried to make it that the number one fund is a bit more aggressive, and the number two fund and three and all that, they go down in terms of aggressiveness by buying more bonds instead of equities. But still, it still doesn't give you that I want to buy only stocks option, right? Or I want to buy only bonds option. The 401k, as you know, you can buy whatever you like into it. So if you're in America, you can buy gold into your 401k, or your IRA, you can buy whatever you'd like, but I think not the Nigerian one. I think it's because, again, we're not too investment savvy in Nigeria, and if you allow everyone to buy whatever they want to buy, people will buy crypto, or people will buy property that is not really versed. So I think for now, it's baby steps. We've gone from one fund to four funds, and I think down the line they might allow an IRA type thing that will say if you know what you're doing and you want to trade, they will give you just a stock option where you can then say I want to buy 100% stocks or 80% stocks. Maybe that would allow the younger folks to then invest. Also foreign investments as well. So there's a bit more, I can hedge my Naira. And Labi, when we first started, the RSAs were doing very, very well. But this was when inflation was single digit and all that. I mean, in 2005, when Okonjo-Iweala was in, Nigeria had a very, very long period of single digit inflation rate. So when you are saving for a long period and you have lower inflation rate, the present value of that liability is very, very low, right? The present value of whatever your future liability is very, very low. But now we have double digit inflation. No, there is no investment in Nigeria, none, that is going to pay you double digit return that is regulated. None. There's none. If you go to the bank, stock market, there's none. You can have these things that are not regulated, but there's no regulated securitized investment in Nigeria that's going to pay you to match inflation, i.e. 24, 25%. There's just none. So RSA is more like, I would say, I don't know what to say. I would say the good thing that they've introduced the property side of it, which you can take out money and put in property. But I would like the keep on saving and avoiding taxes. That's where I think the advantage for Nigerian RSA is. If you are not doing the RSA, then you are paying taxes. So the money is still going to go anyway. So you might as well do the RSA and not pay taxes. Let's stay with you, even if the Naira is a bit, dancing. But that's what I'll say. Labi, did you have a follow-up on that, or you're good?
No, yeah, I'm okay, thanks.
Yeah. So do you still maintain your RSA in Nigeria? Just out of curiosity, do you still maintain your RSA, or have you just closed it out?
No. So I still keep the 75%. I mean, when you leave, you're allowed to, get out 25%. So I still have to keep the 75%. But I mean, I am very, very keen about how my money, grows. I mean, there is a lot of complexity as regards to how you can get the remaining 75%. But I just feel, if there is a lot of flexibility around how you play around with our funds, maybe, policymaker can, do something extra. I understand the perspective of the fact that, it gives you tax advantage. But on the overall, when you're also looking at what yield, you've gotten over these funds, you kind of feel discouraged. And another thing is I was doing a life life annuity with one of the big insurance companies in Nigeria, and I did it for over 5 years. And when I looked at my statements, I'm like, if I had even put this money in treasury bills, it would have given me
what do you mean an annuity? What does that mean? What did you do? You give them money?
Yeah, life insurance. Life insurance that you contribute like a certain amount of your
I don't like
money
those things.
Every month.
Go ahead.
Yeah, every month to a particular. They do it more like a savings. So you buy an annuity and you pay a certain amount every month. So you invest it and you see, your balance at a particular, maybe after 5 years, you have the opportunity to, take out these funds.
Yeah, I hear
when
you.
you look at the returns on these investments, I'll say maybe fund managers in Nigeria are also one of the reasons why people don't, put money into all this, don't invest in Nigeria.
Gotcha.
So for me, at the point, I was even thinking, okay, so maybe, you change some cards to naira. When you see opportunities in Nigeria, you exploit that, or you take not exploit, you take advantage of that. But a lot of things are just complex back there that make this investment situation.
Yeah, so let's just talk a bit about what you're doing is called an annuity, right? And let me just give you my take on this annuity things. In the US, they have what they call fixed annuities and they have variable annuities. So what you're doing, you are taking your bulk sum. So you are either buying an annuity, or in your case, you are doing a deferred annuity. You are contributing your amount of money now to get a bulk sum in the future. The way it is used that I like, they have what they call these variable annuities, where they link it to the stock market, where they'll tell you if you invest in this instrument and the stock market goes to stock market falls, you will get $0. So you won't get negative, you just get $0. But if the stock market goes up to say 10, we will give you say 6%. So in a way, you know that you are never going to lose money. You'll just be at 0. But if the stock market goes up, you're not going to get the full stock market's growth, but you get like a 6. So it's like the protection from you if you invest and you don't want to really lose money or to start to owe money on your portfolio. You buy the variable annuity. Fixed annuity is like you're giving them money and they're going to give you a guarantee. That's what you did, a guaranteed bulk sum in future. For me, right, annuities really, like you said, you are locking yourself into a long-term contract in which you don't know what's going to happen tomorrow. It's like buying a bond, but paying management fee on that bond month to month, right? If you're going to do that sort of investment, give yourself some leeway. Maybe the variable one is a bit more, where you can lose money, but you can gain money. With the fixed one, they're going to give you 2%. Or whatever percent, and it's locked in. Look at rates now have gone up in the US, so you're not going to participate in that. It's a bit very, very restrictive, and again, I think annuities should be used for what it's for. Annuities make more sense when you have a bulk sum, then you want to get a monthly or quarterly or fixed repayment over time. So if you have a bulk sum from your pension, or you win a lottery, or you sell a property, then you can go buy an annuity and say, this bulk money I have, I don't trust myself to keep it, so I'm going to buy an annuity that will pay me, quote unquote, a salary every month. If you do it the other way around, which means you are contributing money to buy an annuity, you want to ask yourself, what is your age? What is your idea about risk? Why not just do it yourself? Just buy an ETF and do it yourself. So in a way, you should be very careful about those investments that lock you in for a long period of time. If you want to lock in, buy a bond. But why are you buying a bond if you're just a young guy, right? You get what I'm saying, Labi? If you're younger, you want to ride the variable wave. You have to build a portfolio with more variable income and a bit of fixed income if you are younger. As you get older, you want to start to transit towards fixed income, because what gives you returns is the length of time you are compounding. Fixed income has no compounding. You are making money on your money. But with the variable, when you buy, say, equity, you are able to grow your principal. With fixed income, you can never grow your principal. You're going to make money on your principal, but your principal would never expand. So what I mean is that if you contribute 10,000 naira, even if they pay you 100%, you are getting 100% on 10,000 naira. But if you bought Tesla, just an example, at $100, the $100 could become $200. So your principal has actually expanded. That's the difference. So it has to do with your age and how you look at risk. If you're younger, that's when you want to take all the risk in life, not when you are older. That's just what I'll say. So same thing with your pension, yeah.
Yeah, sorry, just to ask this and wrap this up from my hand, what will you advise to be the investment ratio between fixed income and equity for someone in his late 30s?
I would say you want. There's this rule of thumb we use where we say minus 100 from your age, and the larger amount should be in equities. That's just a rule of thumb. But clearly, if you are younger, you want to do more variable income because you are trying to take risk. And to be clear, that volatility, that risk is what is going to grow the principal. There's also the risk that your principal will go to zero, yes. But unless you take that risk, that volatility, your principal can't grow. When you are younger, your objective is to grow your assets, to accumulate assets, hence capital appreciation. So the bulk of it should be in variable. So even if you did your age, you are 35, 100 less 35, it's not 65, Abi. So you can say, okay, minimum 65. You can even go more aggressive. When I was younger, I was very aggressive in equity. I didn't even do anything fixed income. But that's me, right? You should always have a bit of shock absorber, maybe 10%, 20% in bonds if you are younger. But as you begin to get older, you want to look for things that can cushion the fluctuations in your portfolio. So you're looking at property, you're looking at bonds, you're looking at, like you said, annuities or even commodities. But when you are much, much younger, you want to buy, assets of companies that are going to grow, and then you can grow with them, and hopefully in future they can pay you a dividend as they get mature. That's how I put it, Labi.
Yeah, thanks.
Yeah, you're very welcome, bro. I do. All right. Hey, David. No worries, Labi. Labi, thanks a lot. I appreciate you coming in. Hey, David, what's happening?
Okay, hello.
Hey, what's up, Labi? David,
Hello,
go ahead. Yeah, hi.
Hello, okay. Thank you for this opportunity. So I wanted to ask, I was thinking, is it possible I have two questions. One is this housing fund. When I was in my company, I was contributing this housing fund, but now I am not actually contributing it. So I was asking whether this housing, is it a national housing scheme, NHS, I can't remember, but whether it is tax deductible, that's number one. And again, whether it is possible that I can contribute some certain amounts into that housing fund and liquidate everything, because what I'm looking at is maybe work for some years, build up capital, then push it into one business while I'm still working. When the business becomes very stable, I can decide to pull out from the work I'm doing. So is it possible to do something like this?
Not really. Go ahead. Let me just take a question that you are asking. So first of all, it's not the housing fund. It's just the retirement savings account in Nigeria. So it's not related to the housing fund at all. The National Housing Fund is on its own. This is just the retirement savings account has now got a window to say if you contribute, you can use 25% of your contributions, right, towards paying for a mortgage. That's what they're trying to do now, yeah.
Okay, and another thing is also, if this thing, if it can also be applied to this pension, whether I can put some percentage of what I'm earning now, above what the pension contribution from me and my organization, maybe in the future, maybe 5 years or 10 years time, pull out some money from the pension savings, then invest it into business. Is it possible, or you must wait until you retire?
Yeah, so remember, right? Remember, it's not an investment scheme per se, right? So they're trying to set up a pension scheme for you. So yes, to your first question, you can do an additional voluntary contribution in Nigeria. Same thing in the US, you can do an individual retirement account and make contributions as well that are occupationally, like an occupational pension scheme. You can do that as well, right? The difference is that you can't take it out as in you can't take it out to do business and put it back in. No, you can only take it out to pay yourself an annuity for yourself when you have retired. So because why? Because there are tax advantages. If they allow you to put the money in, then that's the way for you to avoid paying taxes, and then you can simply pull it out and then just use the money. So it's not going to be allowable for you to put it in, take it out for the business. No, it's going to be for yourself. If you own a business, you can save money for yourself, and then when you retire, you can pull that money out for yourself. I think it's dropped. David, are you still there? All right, David. So that's just to explain. And again, David, like I always tell people, there's nothing stopping you from putting your entire family in an RSA arrangement. If you have your own company, you can employ your wife, you can employ your kids, you can put all of them under your company, and you can pay them pensions, basic housing, transport with a paycheck. What you're doing is creating a form of long-term tax-deferred savings for your family. There's nothing stopping you. If there's no law since you can't do that, right? So if you want to do that, you can. And then you can say, okay, I pay my wife X salary. If you pay your wife X salary and you pay the money into your pension scheme, for now, nothing stops you from doing that. But you can't take it in and take it out. It's got to be there when your wife retires, she's got that income there waiting for her, tax-free, right, that she can draw off. Same thing with your kids. If you employ your kid when he's 16 or 18, and you are paying him you are paying him basic housing, transport. Your kid is 18, he goes to university, you are still paying him, but it's working for you. Your kid now starts to work for a company. Look how long it's going to have those funds in an account that is compounding and earning interest. And you can do the exact same thing in America with an IRA. You can open up an IRA for a child as long as that child is earning. You can't give him money. He's got to earn that money. So if your child is cutting grass or washing the car and that's his job, you are giving him a job with a paycheck, you can open up an IRA for him and he can use that as his first contribution, tax deferred up to a portion. So nothing stopping you. I would say go for it. And yeah, take advantage of the laws legally and do what you want to do. That's what I would say. So I hope I answered your question. I know you dropped about, but we did answer your question. And then you asked about the returns. The latest returns I'm seeing, right? The average industry average return for the 19 PFAs is about 10%. 10%, 10.09. That's the average I see for about all the PFAs. And remember, they're doing this with lots of bond investments and only do a lot of equity. So they're actually doing very well to even hit 10%. I mean, yes, it's not beating inflation, but like I said, there's no investment in Nigeria today that is securitized and official that is beating inflation. So this is tax-free return, 10% on the about 19 PFAs. This is for Fund 1, and that's the most aggressive because that's where they have equities. If you go down to Fund 4, which is mostly retirees, that's doing very, very poor at about 6% because they have a lot of fixed income there, and fixed income has been doing a Yahoo going like back and forth. But for the Fund 1 that has got most of the equity type investments and more of the exposure to the equities, about 10%. All right, I've got Adesanchi. Did I get that right? Adesanchi, what's up, sir? You've got the floor.
Yeah, hello, Kalu.
Hey, how you doing, man?
Thank you so much for bringing up a space like this. Can you hear me, please?
Yeah, very, very well. I can hear you. Super.
Okay, great. So I work with Here's Insurance Group, and immediately I saw this topic come up. I intended to join from the start. So for me, I think you've covered most of the things that needs to be covered, and what I would say is that to be able to access your RSA account, according to the law, which is the PRA Pension Reform Act, amended 2014, the person has to be over the age of 50. To access the 25%, the person must be over the age of 45. But according to that law, Section 7, subsection 2 says that an RSA holder attaining the age of 50 or at retirement will be able to use whatever is left in that account for either lump sum, program withdrawal, or annuity. So I also heard what Labi was talking about when he spoke about annuity, and I love the way you explained it. It's actually very, very clear. I don't know which particular policy was sold to him, but I would say that's a deferred annuity. He purchased a plan that is kind of like an additional pension plan, and that could be converted to an annuity later. So annuity in Nigeria right now is you bring a lump sum, the kind of annuity that we currently have in Nigeria that is, widespread, is you bring a lump sum either through your RSA balance, or you have you have that cash with you, and then you bring it in, and then we help you lock down a regular amount, that you receive from us monthly, quarterly, biannually, or annually. So that's something that I felt I should speak about.
Excellent point.
So thank you very much. I will remain in the space.
Yeah, sure.
If you need my help on anything.
Yeah, sure. And just the point me, it's when you retire or you are 50, whichever is later. Have they removed that clause?
Whichever is later. Thank you very much.
Okay, okay. And then also just to clarify, so in Nigeria, we don't do say deferred annuities. We don't do the ones you contribute and get a lump sum. We do lump sum and get a contribution. Is that it? Just to be clear.
Okay. To clarify that, there are plans. There are kind of savings, investment, endowment plans that you can do with the life insurance company. Now, at the end of that plan, you can convert the balance, whatever you have at the end of the plan, to annuity. So that's how we do the deferred annuity.
Do we have, say, variable annuities in Nigeria where I could come in and say I want to play the Nigerian stock market, and I want to do I want to set a bottom of 0 but a cap of, say, a certain amount? Do we do that in Nigeria?
Oh, okay. Are you talking about specifying where you want to invest your money?
Correct.
We do not have that unless after you have you have collected whatever you invested at the end of the time, and then you decided to invest it in a money market or any of this.
Gotcha. Makes sense. Yeah, because in the US they do have those schemes where you can buy a variable or a fixed annuity, and you can earn. I mean, the key thing is that the annuity is to build up a nest egg. That's the way it's supposed to be structured, right? I do an annuity to build up a nest egg, or I buy an annuity to, should we say, spend down the nest egg. So I get you. A good point. So hang in there. I'm sure folks might have questions for you. So we have an expert in the house from Harris. Thank you. Victor, what's up, man? Victor, how you doing? What's up?
Yeah, hi, Carlo. Good evening. Thank you so much for bringing me on the spaces. I appreciate you. This is a little bit of a digression because I want to go back a bit to what you and Lavi were discussing. You mentioned something about, having a kind of a diversified portfolio depending on your age and how to transition from one portfolio to another. And a thought just dropped in my mind, and I wanted to ask a question. So I am in my early 30s, and I'm more like going for the equities and less of fixed income and all that. But I have a challenge, and that's one of the reasons why I have this bias towards this pension scheme. And it's about the whole this concept of what the future, since we don't know what the future looks like, right? So I'd rather put my money into something that I can monitor within the next 3-5 years, and I'm sure of what's coming. Like Labi stated, how when you look at the returns and
Hey Victor, I think you dropped off a bit. So Victor,
check the both of them.
Victor, I don't know if you noticed, but
yes,
you dropped off a bit. Yeah, but go ahead.
Can you hear me now?
Yes.
Okay, great. So I have two questions essentially. I have So I know that, for example, if you want to invest from Nigeria, because I'm in Nigeria, you're going to invest in Nigeria and you can use these fintech brokerage applications like Bamboo or Shaka, but I still have the challenge as well. What is the future for apps like this, and how sustainable is the model? I know that they are registered with the SEC, but if I'm moving towards the equity area and I'm concerned about the future of my funds because some of these fintechs can have issues, and then if I decide to go with probably a pension because I want safety of my, when I'm done working, I want to be sure that I have something that is secured somewhere, and that too, there is also a level of uncertainty there too, because yes, some of them are private, but then I know one of them that sells the kind of product they sell is bring an amount of money, and then after like 5, 6, 7, 8 years you can now, so the whole business strategy looks attractive. But what if something happens? It's a fintech, and anything can happen, and then I'm going to be told stories about all my contributions, and I may not be able to get anything back. So same with the equities, and then versus going with a traditional brokerage like Meristem or Stanbic IBTC, which may not allow you to invest with as little as, let's say, $1. I don't know if they do that with traditional brokerages, but you might have a certain level of income bracket before you can invest with traditional brokerages. So I guess my question is just, what does it look like managing this unforeseen nature of investment? If you can just give some clarity to that.
So for the good question on the future of fintech. When you buy US stocks using those Nigerian-based fintech, I think there are 3 that are registered in Nigeria right now. I think there's Chaka, there's Bamboo, I believe there's Cowrywise. Those guys are registered in Nigeria. What you are actually doing, those guys are the front-facing, should we say, the interface to trade in the US market. You're actually buying through something called Drive Wealth. So if you Google Drive Wealth, that's actually the broker that you're actually buying your securities through. If you remember, we used to have a company called Passfolio, and Passfolio left, and a new American company came, and they basically were writing to Nigerians. Nothing happens to your holdings; it just goes from this place to that place, but the actual holdings, what you own, is still kept in custody, either with Drive Wealth. That's the real guide that you are going through to get to the US market. So let's assume a firm folds up today. Try to get in touch with the actual custodian or with those guys and say, I had an account with these folks and I'd like to get my funds back. They'll sort you out. Literally, if you want your certificate, when you buy a US stock, if you want the actual certificate, you can get it, but it will take you time. And why do you want to get it? Because if you get it, then you have to then convert it back to the digital copy to sell or buy. But it's not impossible. All I would ask you to do is that when you buy, you can always request and say, give me a trade confirmation, right? To show that my stocks have been bought. And then you keep those copies with you, so you can always go back and say, hey, Drive Wealth, I bought through these folks, and they're no longer in existence. I'd like to get my share certificates. They'll always come back to you. So these guys are all front-facing. Yes, do your due diligence, but in effect, it's a good thing to buy. And just to go back to the idea of diversification, right? So if you're in Nigeria and if you're in the emerging market, it's always good to have an exposure to the US stock market. You know why? If you pulled up a chart, just ETFs alone, just ETFs. If we pulled up a chart of the ETFs that have performed the best over a decade, and we're talking about all asset classes, Japanese property, US equities, Nigerian bonds, whatever asset class, commodities you can think of, the ETF that has performed the best over 10 years has been the ETF that invest in US equities. So the US equity market is the largest, most liquid, and most profitable market. They do better in the Nigerian market, right? The US market. Why? Many reasons. Facebook, all those guys are all on just one market. Imagine you have Amazon, Apple, Facebook, Snapchat, all on one market. So they've delivered that market 10 years as a whole. They're the best performing. What's the second performing asset class in the whole world? Same thing, all asset classes on ETFs. US properties, like if you do VNQ, That's US REITs. That's where you basically get exposure to US properties. So if you are in Nigeria and you're earning Naira, it makes sense to diversify away from your country, away from your currency, into another country, into another currency. And the easiest way to do it is to take your Naira, get an app, and buy an ETF into the US market. Why an ETF? Because you don't know what to do. You don't know the US market. So you simply buy an ETF like, say, VTI. That's 5,000 specific stocks in the US market. If you say buy VOO, that's 500 stocks in the US market. You're buying Tesla, Microsoft, everything in those ETF plays. It's a cheaper, more efficient way for you to get that exposure. So if you are building that portfolio, keep that in mind. Do your Nigerian exposure in terms of bonds and equities. Also do your US and foreign exposure. You can do the US, you can do the whole world. If you buy VO, that's VT is the entire world. VTI is the US. VXUS is the whole world minus the US. So there are many ways you can diversify. But the key is don't put all your eggs in one basket, right? Try to spread out. That's really why we advise that you diversify. How you want to do it? Yeah, but make sure you diversify. TSL, man, what's happening? How you doing?
Hey, Kalu, first of all, it's always a pleasure to see you. It's been a while. I've changed up my little profile. If you look at your DM, you'll see me there. I had a different name before. But either way, I've been dying to ask you this question for a while, so I'll ask you now. What is your opinion, your perspective on lithium investing or opportunities in Nigeria or any one of the ECOWAS nations? And the second question is, what is your opinion of infrastructure development for EV in like ECOWAS nations? I have a perspective on what's happening in East Africa, but specifically in ECOWAS nations, of course, in Nigeria. What is your opinion there?
I think that when you talk about mining, where is the money made? Is it in the mines, or is it in the Tesla, the actual end product, or is it in the actual guys that buy and sell the commodities? That's basically your question. Where is the money made? That's where you want to invest.
The infrastructure.
Yeah, but okay, let's real life example. So Congo has the largest lithium deposit in the entire world, right? So if I was going to invest in lithium, should I go to Congo or should I just go to the US and buy maybe Tesla stock? Which one would you be more? Which one do you think you can invest in? You can invest in Congo. One, you can't track it. I mean, how you sure of the risk rating? There might be a coup tomorrow. I mean, it just be realistic to you, right? So there are ETFs that really you can invest in that have an exposure to commodities. It's actually a lithium ETF, technically. If you want to buy a lithium ETF, it's called LIT. So you can buy that stock and you give them all the worries. You can say, hey, these guys are basically going to buy anything lithium in the entire world, and they are quoted. You can buy it. I'm looking at their 30 days yields, about 1.84. They pay you dividends, semi-annually and all that. That's how I like to invest, the easiest way. Now, if you want to make more money, of course, you want to go down to the source, which means you want to go to Congo and try to invest in someone that does this lithium logistics, either the mining, the refining and all that. Then you make more money, but there's more risk. The Chinese are there, they don't share, and all that. So it's really your risk level and your comfort level. If you can't go to Congo, buy the ETF. If you can go to Congo, or you can go to Argentina or to Chile, then go there, of course, and buy those specific stocks. You don't have to buy the ETF per se, but you can buy the specific stock that deals in that specific, asset class, and then you are there. And I can give you a few names, right, that do lithium. Look at ALB. So ALB, they are large. Even Samsung, they are large as well. LG Energy, the ticker are all there. Just Google it. Just Google ALB, or if you don't do Samsung, it's from this one. So it's too.
No. I mean, it's okay. I've actually invested with a few ETFs, and I do some SPX trades as well. But I was actually more interested in your opinion of, do you see any kind of infrastructure happening specifically in the ECOWAS nations for EV infrastructure development.
I saw a tweet by a Nigerian company. They do gold, and they said that they have basically got a license for lithium. The same guys that do gold in Osun. I'm trying to find the name. I know it's on my Twitter feed. I can look for it real quick. They just said they have now gotten a license to go into lithium mining in Nigeria. So that might be a play. The problem is that they're not quoted. That's the thing with all these mining guys. They're not quoted. I saw the Minister of Power, not Minister of, is it Solid Minerals, I think, the Dele Alake. I saw him in Australia. He was talking with the Australians to do something. So something might be happening there as well. You know, if you want to invest, there has to be an outlet for us to invest in. So I don't know if you've seen the pictures of gold mining in Zamfara. It's just large open pits, folks mining gold without any controls whatsoever. I'm pretty sure where do you think the money is being made? Those guys mining that gold are getting nothing. There was a long time ago, I believe it was in the early 2000s, there was lead poisoning in Zamfara, those states. And lead is how you mine gold. So someone was just taking the lead and using the lead without controls. And there was serious lead poisoning. What lead poisoning does, it stunts growth. And that thing was just pushed under the carpet and all that. And it's still happening till today. So those guys mining there are getting nothing. The real returns are being made by the guys exporting that gold illegally to Dubai to sell. So the question is, how can you invest in that value chain if it's not registered, not regulated? There's just no way. There's no mining stock in Nigeria, right, to invest in. The highest you can get is going to say you want to invest in the diesel. And there's just nothing to give that gives you exposure to that asset class. Even the ones in Ogun State are also not quoted. So, you know, like I said, buy the ETF and hope the ETF guys will have a better way to invest that you can't get to. That might be a better way for you to go about it. But I'm open to your suggestions as well.
Oh, no, I hear you. I wanted to hear more from you guys. You guys are much more familiar than I. I've been hearing about, I know the motor KKs, I've been hearing about people trying interest there of swapping the gas for electric and having some unfortunate shortcomings, but it's fascinating to see the interest there. And I know that there are people like in Victoria Island and what have you, and Lekki that have Teslas, but you know they can't go that far because they don't have a fast charging network.
I mean, using the Tesla in Nigeria is I don't know what to call it, because unless you're going to just go within VI and Ikoyi, which makes sense, you know. So you charge in the morning, then you can drive around VI and Ikoyi, which makes sense, you know, and it's way cheaper, right? I had a friend that had a Tesla in Abuja and charged at home, but you can go around Abuja and all that. But apart from that, we now have electric buses, so the buses also make sense. Maybe it's gas to electric, then to charge them, and we have tons of gas here. So I personally think Nigeria should focus more on the gas powered cars than the quote unquote electric powered cars, because you want to push what you have. You know, Tesla is using electricity. We should try to do CNG. And if I was the president, right, I would just go to Innocent, go to Nord, go to all those local guys and give them such a deal that any car coming from Innocent is going to use compressed natural gas. Triple or quadruple their output. Make it literally 10K. Just pay for Nigerians to put CNG in their cars and to use CNG. Then target West Africa, you know, and just go, hey, the fuel for cars in West Africa will be CNG. Once you spend money, you can spend $10 billion and get that market locked in. But what happens after? They have to buy the CNG, which we have surplus of. You know, when Jimmy Carter came to Nigeria, Nigerians didn't eat bread. No, we ate other stuff for breakfast, but we didn't eat bread. Bread wasn't a staple in Nigeria. Jimmy Carter came here and the West flooded Nigeria with wheat, cheap wheat. They got us hooked on agege bread. Then they started to raise the price up. Now agege bread is a staple. It's literally called agege bread. It's imported white, flour and all that kind of stuff. So we have a lot of gas. We're talking all this green. Our green should be CNG. The West says gas is dirty. That's an easy thing to fix. Go pay some lobbyists in Washington. Pay them to include gas as clean energy. And then Nigeria can then drive gas, just target ECOWAS. The payoff from using Naira to buy gas, from using Innocent Nord, all those local companies to export CNG-enabled cars. It's just amazing. Why are we doing electric buses when we have CNG right here? I don't get why are we doing it, but, hey. All right, bro.
No, I hear you. I appreciate it, man.
I hear you, man, yeah.
I got one last question. If you were on a board that had to determine and advise, let's say, a company like Tesla to set up a massive factory to manufacture both batteries and cars, which country, sub-Sahara, would you advise them to consider? And I'll wait until listeners report take my answer. Thanks so much.
It's just going to be Congo. That's where the raw materials are. Unless they're going to take them, they're going to establish it next to Congo. Congo is next to Lawless, but that's where the raw materials are. They literally have places there run by warlords. But everyone in the world is there, and everyone in the world makes money there apart from the Congolese. The richest country on earth should be Congo. Not just the raw materials, even the river. The Congolese river, if it's dammed to produce electricity, they can export more electricity than, say, Saudi Arabia or whatever. But our country really has just gone through hell. From Leopard, going there to do a rubber estates to what we have today. And it's just amazing. The whole world just goes there, takes their stuff and leaves. And the country is just not going to be a country. So I wish the same way they do Kimberley process for diamonds, the same way they go in and they say, hey, we want to protect the Alaska wildlife, there should be something to do with Congo to say you just can't go in there. How many nations are there? So I would say Tesla would have to put it in maybe in gigaplex, battery gigaplex in, say, Congo, and hope that maybe they can bring some normalcy around the town where he puts it in. Because outside Congo, where else would he put it? What's the country around there? Gabon is near there. Sierra is rubbish. Maybe Nigeria, but he has to bring the things all the way to Nigeria. I don't know. He needs a place he can make batteries and export them. So Congo has got a port. I guess so.
I appreciate that, man. Thanks.
You're welcome, bro. John. Hey, John, what's happening? We've got you on the floor. Go ahead, sir.
Hi, Carlo. Thank you so much.
Hey, John, what's happening?
Sometime last year, you brought up some ladies from FCMB
Yep.
to talk about shares and investments, some products in their banks.
Yep.
And me for one, I tried several times because I'm not in Nigeria. Tried to register, the documentation was the problem. I tried again. I saw similar stuff again on Guaranteed Trust Bank, GTB. I tried, was the same thing, uploading the documents from here. So my question now is are there people you can actually introduce? Because, Carlo, I've never met you, but I trust you. I've been following you, and I know what you say is gold. Are there people that you can give me names that we can call directly that will make these things a lot easier for us? That is first question. Second question, you said so much about US, Canada, Nigeria, which is good. Nigeria is our country. But what about those of us in...
He dropped off. John, I think he dropped. Is John still there? John, you dropped off, and just when you're going to say,
Oh, sorry, was the call that...
yeah.
When did I drop off?
You said, what about those of us in
the UK?
In the UK.
Yeah, because you do a lot of investment opportunities everywhere else.
I got you, bro.
I appreciate the fact that you do the one in Nigeria, which we are very much interested in, and thank you. But come on, some of us just live here in the UK. We don't know much about investment opportunities.
I hear you.
If there are things you want to do that we can jump on, I would really like to hear that.
Yeah, I completely get you. Yeah, guilty as charged. The thing is, I try to stay where I know a lot of. I know Nigeria, I know US very well. Canada, not too conversant. I'm just because I have to know Canada. UK is one. Yeah, UK is. I have to do more for UK. Maybe I have to do a lot more research and then come out and then speak. But good point. Good point on UK. Just to be clear, right? Whenever you're investing in the UK and the US, those things are totally different, which means that if you have an ETF in the US, it's not the same as the UK. It's the exact same ETF, right? But they changed the name. That's why I stopped talking about the UK, because VTI in the UK will be the exact same components, but it'll be a different name, because the way they do their mutual funds in the US and unit trusts in the UK are completely different for taxes and all that reporting. So, but you're right, guilty as charged. We will try to bring some experts, some heavy players in the UK, and just let them to speak. Maybe I can just look for one or two guys that know stocks in the UK, know property in the UK, and know fixed income in the UK. Invite them in. If you know anyone, send their names to me. I'm going to ask my plug to bring one or two guys. We will have a space on just UK investing, and I should bring that to you a month or two. I should bring that to you. To your question on call to invest in Nigeria, are you asking for a person you could call to invest or to send your documents to? Because I think Nigeria always needs this KYC. Are you saying you want someone you can mail your KYC to, or what are you asking about call to invest in Nigeria?
Yes, okay, when those ladies came on, you remember when you were doing the FCMB?
Correct. Yeah.
Product?
Yeah. Correct.
Yeah, it was sometime last year.
Yep.
And the problem was they told you go apply online.
Yep.
You did. Upload these documents, you try, you don't get through. Upload that document, you try, you don't get through. I jumped on Twitter, I went and, not that I didn't put them on blast, but I actually expressed myself bitterly. They came back, tell us exactly. I did that again and again. Up until now, I have not been able to do anything with any penny, with either the FCMB or the other one that I saw that's very, very similar. So what I'm now asking is there someone that you know that you can say, hey, these guys have problem with this? Is there a way you can help them?
Gotcha. Okay, I hear you.
Yeah.
All right, send me a DM and just say, Kalu, send the same kind. I remember who it is. Just send me a DM. Send it to me now. I'll send it to someone and they'll give you a call directly. You want it from FCMB, correct?
FCMB, GTB, either they do pretty much same thing.
Okay, I brought FCMB to talk about their mutual fund products, the dollar one. Yeah, and I mean, imagine if we had bought that dollar, I brought that dollar product that FCMB was offering. So that,
imagine then.
Yeah, imagine then. I know I told you people to buy you. Now it should have gone up in price considerably because the dollar has gone up. So if you had bought that FCMB investment that we brought over here, you would have made out like a bandit, right? So yeah. So send me that. Send me that DM.
I'll definitely DM you now. Thank you.
I will definitely send it over to to the organs there, and they should get back to you. Yeah, and I'll send I think their name. Let me just share their handle on Twitter, just in case folks want to check out their offerings. So it's FCMB Asset Management. So if you go there, you can see their offers that they had. They were basically mutual funds that you can buy Euro bonds on a retail basis, right? So that was a big thing there. I think, yeah, if you had gotten in, good for you. Yeah, I'll follow up. All right, so FCMB Asset Management, I just shared it on the handle. Yeah, go for it. All right, super, thanks, man. Let me go back to the DMs. I always have, oh my God, I don't know. So is it true that I can take my money, my RSA from Nigeria and transfer to the US into a 401k? I would say yes, because I know for a fact there are some foreigners that work in Nigeria, and when they are retiring, they request to have either a letter or a check to confirm that this check that you're giving them is from the RSA and it is their retirement savings. So you do a letter and say this is your emolument from your retirement. So they know that when they are taking it across borders, that those funds have already been taxed. I know one guy that did it. I'm not sure because of double taxation rules, but I would say this just as advice. If you are going to America or to Canada, right, and you have money in your RSA, just get your documentation right. Get a letter from the RSA and say, this check represents my pension savings. So you have a cashier's check, or you have a check, you have a letter from your organization or the PFA saying this is your pension contribution. When you go abroad, then open up an IRA. Open up an IRA and then put the money into your IRA. You can take money from your IRA and contribute to a first-time home buy, or you can just put that money in there and it is not taxed because it is below. Every year you can contribute 6,500. So that's a good way of just taking that money in Naira. You take it as a letter. You can ask them to maybe to give you, they can't give you a dollar check in Nigeria, but you can take your Naira, then convert it to dollar, and then have something that says I was paid 10 million Naira and I converted it to so dollars, and this is the check for that conversion. Go abroad, put it into your IRA or into your 401. You can't put it into your 401k, but into your IRA. Now, the thing is, when you have that money there and you want to make a purchase of a home, you can say, I'm taking this money from my IRA and the proceeds are from Nigeria. It's documented. It's not like money laundering. It's right there. It's not a loan. It's not a gift. It's actually your emolument that you have brought over from the US to Nigeria. So it's something you want to document because they don't want you to do a gift. They want to see it's part of your income that you can afford that home. So that's why you want to look at it that way. Other question: why don't we? Let me see. Does the Canada have an IRA? I'm not sure Canada has an IRA. I think the Canadian RSSP does not have a contributory limit on it. So the Canadian retirement funds, they don't have a limit to contribute. Labi, am I correct? You can contribute as much as you like into your RSSP. US has got a 6,500 cap on IRAs, but for the RSSP, I don't believe they cap that. So you can contribute whatever you'd like, and that's, I think, the key difference with them and the IRA in the US. For Nigeria, I believe you can do 25% contribution to your retirement savings account. In the past, you could contribute whatever you liked into your retirement savings account as an additional voluntary contribution. But I think now they've capped that contribution, or they've said if you put the money in, you can't take it out unless it's been there for 5 years. Let me give you guys a hack, right? If you want to buy a stock and you think that stock is going to go up in price, right? And you want to just, you know that this is going to go up in price, and you know, of course, in America, if it goes up in price, you're going to pay taxes. You want to buy it into your Roth, your IRA. So if I bought, say, if I bought a particular stock and I bought it into my Roth IRA, even if it goes up in price, I don't pay any taxes when I withdraw it. Because when I put it in, I already paid taxes. So that's a tax hack right there for America. Anything you put into your IRA, you're not going to pay taxes even when you withdraw, as long as you withdraw it 5 years from when you put it in. So if I want to buy stocks in the US and I think those stocks are like, maybe there's a small cap stock that's going to blow up, if I buy it into my IRA, then the stock blows up, I don't worry about capital gains taxes because it's in my IRA. Although I'm restricted to only 6,500, I'm not going to worry if I take it out in the year 6 because I've already paid taxes 5 years ago. That's why you see Peter Thiel, he's got $5 billion in his IRA and he's not going to pay taxes because when he bought Facebook and put it into his Roth IRA. So that's a hack for you right there. right? All right, listening, can you talk about direct investing in U.S. government bonds, either through treasury bills or EE bonds, as a Nigerian living in Nigeria? First of all, if you want to buy any U.S. investment, you have to have a social security number. The only way you can buy U.S. investments without a social security number is if you are buying through, say, an app like the ones we talked about, Chaka, Bamboo, Cowrie, that are already registered in Nigeria and would then use your Nigerian identification. That's the first thing, right? Now, if you then are able to then cross that first hurdle and say, yes, I want to buy bonds, I'm a Nigerian, can you buy US bonds? Of course you can. If you want to buy bonds, you can buy it through an ETF, an exchange traded funds. And one of the most popular bond ETFs is the BND. That would buy you bonds, fixed CDs, fixed income instruments issued only in America. So BND is sold by Vanguard, so very, very low cost for you to get into that bond. If you want to buy directly, you can buy a savings bond, what they call Series EE savings bond. So if you have, say, a SOC, or you're able to buy directly, then you can buy savings bonds. And savings bonds, basically, you can buy them, they pay you interest monthly, and the interest is compounded semi-annually, right? And the way they work is this. If you notice a few years ago when the US inflation was almost 8%, you had these bonds paying you almost 8% as well. It's because they split the interest in half, and they pay you the interest based on the inflation rate in America at the moment. So if you buy the TIPS, the TIPS. So what happens is that when you buy the bonds, if interest rates go up, then a part of your interest will mirror the prevailing interest rate, i.e. the Fed rate in America, and then you get that higher interest rate. So I would say the key things to watch out for, you can't buy it unless you have a social. If you have a social, you can buy it directly. If you don't have a social, you have to buy it through an app. You buy an ETF. Why? Because it's cheaper. It allows you to diversify real quicker with a little amount of money. So with $25, you can buy into a bond fund than having to save all that money and buy yourself. If you want to buy series bonds, which are you're buying directly, like the EE bonds you're talking about, you would have to basically have a social, or if your kids have a social, you can buy in their name, and you get the advantage of interest that's compounded semi-annually, but it's paid monthly. But again, it's going to be your age, right? If you're not old, why are you buying bonds, right? If you walk into a US bank today and you give them monies to invest in a certificate of deposit for 5 months, those guys are paying almost 5%. 5% US dollar guaranteed, FDIC guaranteed. So I'm more like, right now in America, the rates are negative, which means if you invest for longer periods, you get a lower interest rate. So longer periods in America will give you a lower interest rate, but shorter periods will give you a higher interest rate. So essentially anything less than 12 months, you get a higher interest rate in America than anything that is more than 12 months. So I would target certificates of deposits 11 months and down, get my 5%, lock it in. If you want to do bonds to match a long-term liability, you can go ahead and do that because you're not worried about the interest rate in the future. That's how I would put you. So I hope that I answered your question, the lady on Twitter, right? How would you advise a 30-year-old to keep funds in a particular stock? If a particular stock, e.g. GT, has done more than 50% within a year, would you pull out or leave it there? If you bought a bird and the bird was giving you 50 eggs a week, why would you sell it? Why? Why? What's the need to sell it? I'm just wondering, right? If you sold it, what would you buy? If 50%, if it's giving you 50%, is that capital appreciation? That's fine. But what is it doing in terms of dividend yield? So if you want to compare if you should buy or sell, you want to ask yourself, if I sell, what would I buy? So you want to get the dividend yield of that particular stock, Balogo. Then you want to compare it to the dividend yield, to the dividends or the coupon yields of other investments around you. So what is the yield of a treasury bond? What is the yield of property in Lekki? If those options are not paying you as high as the dividend yield of the stock, then you keep the stock. Why are you selling it, right? So compare. The first question is, what is your return? Not the capital appreciation, but what is the dividend return? And how do you calculate dividend yield? It's going to be the dividend that has been paid to you divided by the cost of buying that property or that investment. So the dividend yield of a house in Lekki is the rent divided by the cost of buying the house. Then you compare rent, dividends, bonds. Which one is paying me more? If dividends are paying you more, then why are you selling? Because if you sell, where are you going to put the money? So you might as well just hold the money in the stock, or you pull it out to consume. You can pull it out and go on a holiday. It's your call. But if you want to take it out, you want to ask yourself, where would I put the money? Because the money, where it's going to go to, is the cost of you taking it out, not really the cost of the investment. Let me say it again. The cost of you taking out your money from that particular stock is the cost of where you would have taken it to. So if the cost of where you're taking it to is lower than what you're making right now, then it makes no sense to sell the stock. So Balogo, I hope I answered that question. Mr. Akin, you've got the floor, sir. Go ahead.
Yeah, so my question is about how possible it is for Nigerians to have exposure to the Russell 2000, because yes, it's all well and good to invest in the S&P 500, but then some of the best returns that an investor could get in the market could be investing in a $500 million market cap, $1 billion market
and
cap.
actually, just to explain, Russell means the low cap, what we call the SMEs in Nigeria. Just so we follow. Go ahead, sir.
Yes, the SMEs. So like the Russell 2000 and the Russell 5000. So last week, the reason I asked this question, I've always thought about it, about getting exposure into the Russell 2000. This is probably over 10 years now, but then last week I was in a space with a few micro-cap investors based in Canada and the US, and there were a lot of like ideas that they were bouncing off the participants in the space. And when I went to Bamboo to check the ticker symbols for these companies, I could only find, I think, only 2 or 3 out of 10 ideas. And the thing is, yes, you could argue that these investment managers are talking their book in the sense that they're hyping up their own investment, but then if only just 2 or 3 actually increase by 10, 20, 100 fold, you could make a huge amount of money, like a lifetime worth of money on those investments. So I was also wondering how one could get exposure to them, either through a mutual fund, through an ETF, or something of that sort that maybe one could just buy that would give one exposure to the Russell 2000 and the Russell 5000. So those are these SME indices in the US markets for people that don't know what they are. Thank you.
Yeah, so if it's to get the specific ETF that you can invest, I can give you a quote right now. I do mostly Vanguard, so I would give you one right here. But so if you look for, it's called the VRTIX. Yeah, VRTIX.
Sorry, can I DM you?
Sure.
So that you can just send me the ticker symbols, and I could just take advantage of that.
That's fine. I'll post it for you. I'm going to do a screen. I'll post it for you real quick. VRTX. I'll send it. I'll post it up. So Vanguard is the Vanguard Russell 2000 index. Yeah. So if you want to get that, it's right there for you. And like you said, when you buy an SME, you are buying a company at the growth stage. Growth, not value. Growth. So they think that the company is going to grow very, very fast, and you're going to have a high price to earnings. So you may make more money than if you buy a mature stock, but you can also lose money because it's also a small stock. It's susceptible to also crash, right? So I hear where you're going to with that. The return for 1 year I'm looking at for the VRTX is about 12.44%. 1 year. Over 10 years, 8.35. Not bad at all. So over 10 years, 8.35. So it's something that when you want to diversify, if you're buying small caps, you are doing the equity. This is the high risk equity. You are buying the growth stocks in America, the guys that employ more people, that are more on the ground in America, trying to make a profit. More. It's not mom and pop. These are like big time SMEs and all that. But that's a way for you to participate in them. So remember, it's high return and it's also high risk. So I'll post that tweet of VRTIX, and that's your exposure to the small caps if you were interested in that, Aki. So, Aki, are we good?
Yes, thank you very much.
Yeah, I'll put it up. All right, excellent. Hey, Mr. Ugochukwu, what's happening, sir?
Yeah, Carlo, thank you so much for having an avid follower, and I've benefited in terms of information, so I'm very grateful.
You're welcome, sir.
Yeah. I want to ask about, you mentioned certificate of deposits at 5% within 11 months. One, I want to ask, do you think 5% is a good deal? And secondly, 11 months, is it 5% after 11 months or 5% monthly for 11 months?
So it's actually 5% from what I've seen, from 5 months to 1 year. It's actually 5% for 5 months to 1 year. And whenever you see an investor guy say a quote, we're always saying per annum. So when we say 5%, we always mean per annum. So in America, it's the APY is 5%. The annual percentage yield is 5% minimum. That's what I've seen, minimum all across America. To answer your question, my God, it's a very, very good rate. 3 years ago, rates in America were 0.25. That's rate in America, 0 to 0.25 years ago in America. This is not just 5%, Ugo. It's guaranteed by the US government. So you can walk into the bank can be called Kalu Bank, and you are guaranteed 5%. Even if Kalu Bank takes your money and buys pepper soup, the US government is going to pay you 5%, no risk. How is it not good? 5%. The Nigerian bonds, when we issued Nigerian bonds about 6 years ago, we were paying 8.5%. And it was a very, very good deal because Americans were paying maximum 2%. So Americans would be like, wow, I could borrow money at 2% and invest in Nigeria at 8%, and Nigeria will pay me 8% for 30 years. So you see, easy life. You borrow at 2% or 1% in America, you buy Nigerian bonds at 8%, you go to sleep in Florida. You get your 6% spread. You don't break a sweat. Now, US is giving you the same 5%. But the only problem with this rate is that it's only capped at maybe 12, 11 or so, 15 months. I've seen some that pay 3 years, 4 years. I don't know if they're FDIC, Hugo. But any FDIC you see today paying you 5%, just take it. Just take it and move on. If the rates fall, no problem. If rates go up, no. 5%, bro. What's inflation in the US? Inflation in the US is 2% normally. 2-3% normally. Forget what we're seeing today. Today is based off Russia, the COVID, the Democrats want to do green policies. But usually inflation in America is 2-3%. And someone is giving you 5% guaranteed. So it's a good deal.
Okay, thank you. Carlo, I am new to this thing and I'm trying to learn.
Yep.
I want to ask, for somebody who doesn't have a lot of money, I'm in the US, I don't have money, like I'm not a big boy, but what do you think is the best thing in terms of investment for that person? Like I said, I'm not big, So what do you think is the best thing for that person in terms of investment?
Yeah, so what you want to do, Hugo, you have to start from the very, very beginning and say, why are you investing? Many people invest for many reasons. So why are you investing? Number one, are you investing for long term to retire, or are you investing for short term to trade? What is your investment objective? Once you get that answer, then I can give you this. I can give you the next answer. So let me ask you, why are you investing? Are we doing long term? Is it for a target? Is it for retirement? Give me an answer.
Okay. I have some idle cash that I don't think I might be needing.
Needing for very how soon. Long? For like 1 year, 6 months?
Okay, I can say for a long time.
How
I don't
long?
think I'll be needing it for a long time.
5 years?
But then, yeah, let's say 5 years. Okay, let's say 5 years. But then, the thing is, I am interested in 3 things, like you said, that early retirement, trading, and I am also trying to see what I can do with capital. So I don't really know which way to go.
Yeah, NWC is when you do what he's doing is called PE. When you do what he's doing, you are basically investing in what Akin was talking about, Russell, where you're investing even below the Russell. You are trying to buy into an idea at the very, very, very beginning of the idea. That's what you're trying to do. You're trying to say, I want to get into it. You're trying to buy a Facebook.
Startup.
Yeah, not even startup, correct. You're trying to buy Facebook before Facebook was even Facebook. When Facebook was still doing stuff you invest. That's what you're trying to buy. So imagine the guys that bought Facebook back then, but bought 1,000 shares back then. They are billionaires today. But there are many Facebooks that failed. So the risk for the PE is that you are buying into a PE. It might make money for you. It might crash and burn. I would say this. All the things they tell you, there is no way you can look at an idea and know if that idea is going to be successful. There is absolutely nowhere. It's Carlo. No matter what anybody says, it's a gamble. Let me ask you a question. If someone had told you 20 years ago to invest in a TV station that would only broadcast news, would you have done it? Only news. No music.
Yeah.
Only
it looks
news.
Like it's not for the, it's not an easy call. You cannot just say it to scale.
Of course, there is no way you can know this. No way. Or if someone had told that you should invest in a company, that this company is going to take people's pictures on cellular phones and then put drawing on them. So if you have a face, it will put eyeglass on the face, or it will put a snap on the face. Would you have invested in that company? Is that a serious company to you? That the company will take pictures of girls and then put pictures of eyeglasses, of horns, and put love letters. Would you have invested in that company? Of course not. That company is called Snapchat. If you had invested, you'd have made $1 billion. But no one would have invested in a company that's going to do nonsense like putting pictures on girls' photos. The point I'm making is that we can never know what's going to catch fire. What is Facebook? The guy put pictures of people in UNN and pictures of people in Ife. That's what Facebook is. Facebook. The faces of people in a book in schools. That's all it is. But it's caught fire. He built this empire around it, and now he's a billionaire. The point again is this. You can't tell which startup would make it. Google, what do they actually do? What did they actually do? I'm talking about 20 years ago, not today. Okay, they make search easier, and so what? That's why I should invest in you, because they're going to make search easier. It makes no sense, right? It makes no sense.
Yeah.
So if you invest in that idea and it makes it, you make a lot of money. So the way I look at PE is that just take money you think you can lose and invest it. If you make money from it, bonus. If you lose it, no problem. But let's now move on to what you've said. You want to invest for 5 years and you want your money back in 5 years, correct? This is money you want back in 5 years. I would try to I would go online. Because you want it for 5 years, I'm not going to do any money market. Money market is more of short term. We're talking about certificate of deposits, fixed income. I won't do money market. That's more of short term. So I want to do capital market, longer term. Because you want your money back in 5 years, that means your principal must be protected. Which means I'm not going to buy any growth stock. I can't buy any stock that's going to grow like a Tesla. Because Tesla might make growth in its share price, but it pays me no dividends. So if I buy Tesla today, in the 4th year, the Tesla might crash and I don't have your money back for you. So I want to buy something that the principal is protected, but it's going to give me returns for you in 5 years, which gives me 2 options. I can buy a bond or I can buy a property fund. I can buy an equity stock that has a guaranteed dividend. So I've got 3 choices now. Equity stock with a guaranteed principal, but with guaranteed dividend payment. A company like, say, P&G, people must take their bath in America, they must use Tide, they must drink coffee and all that. That's what P&G makes. So I want to buy those guaranteed dividend payers that are stocks in America. I want to buy a stock company like that. Or I want to buy a company that sells mortgages or homes in America, because you still have to live in a house in America. Or I want to lend money to the federal government of America. Those 3. Because with those 3, you can get the return back in 5 years for you. So I look at the returns of all 3, the dividend yield of all 3, which is going to pay me more. Bonds, property funds, or a value stock. That's what I want to look at. And if you look at all 3, which one do you think would pay you much, much more in terms of a return? My numbers is telling me the property stock, because property in America, some states have no inventory and there are young people emigrating to America every year that need homes. Timber used to be scarce in America just before COVID. So lots of supply disruptions leading to demand for homes, say in Washington, in Florida, in Texas. So if I buy an ETF targeted at residential properties, targeted as new homes, apartment buildings, I might be onto something. The one that protected my principal in that I own the home, but the dividends, they're going to pay me more than 95% of the profits they make. Not 95% return. They have to pay me 95% of the profits they make. That goes back to you. So if I don't want to invest for 5 years long term, I'm looking more like a property fund, like to put my money in, or a value stock that's going to pay me a high dividend rate. That's what I'm looking for. What's a good property fund? If you look at ARR or ARI, that's Apollo. Those guys are paying nearly 10% dividend yield on the property that they have. You can just Google it, ARR or ARI, nearly 10%. Just Google them. You can Google property ETFs. There'll be lots of them. Look for the ones that have been there forever. Look for the ones that are in certain states. You don't want to go to any quote-unquote Democrat state, because those guys do rent control. You want to go for states in Florida, right? You want to go to Texas, where there's large population going in there and where they don't cap what rent that they pay. That's how you want to invest, Ugo. You go from your objectives to go to what stocks match your objectives. Then you now go to the individual stocks and you buy a particular one. If you don't know what to buy, you buy the ETF that buys the sector. You keep it simple, nothing complicated. If you don't understand it, don't buy it. If it's not paying you a dividend in cash every year, don't buy it. Then you have to read on your own to understand what is going on, so you can actually know what's happening. Take $20 and start. All the stuff I told you can buy with $25. Start with $25 and see where it gets you. Understand the terms, then slowly increase your contribution. Does that make sense?
Yeah. I'm sorry, guys. I'm sorry I'm taking so much of your time.
Last question.
You said ARR or ARI. I'm on the internet and I can't really see a link that will take me to something that looks like what I'm looking for.
So search ETF ARR. So search ETF, yeah, then do ARR. What do you get? It's called
residential rate.
There you go. There you go. So look, what's the dividend yield of that? What's the dividend yield? Can you see it?
What I'm seeing is stock price as of today. I think it's $4.8.
Good. So that's an ETF that invests in residential properties. REIT means Real Estate Investment Trust. So you want to research this company as much as you can. They've been around since 2008. So they're slightly a big company. They know what they're doing, right? So you want to do a lot of research and see if this company basically meets your objective. Their net income has been up 173%. Net profit margin for June, 79%, right? So that's what you want to just look out for. Do more research on them and see if this company basically hits you, right?
Thank you so much.
Make sense?
Yeah.
The good thing about investing in the US, bro, is any information you want is available. There's some stuff in America, in Nigeria, I can't get. Sometimes I get Nigerian information by going to the American ETF that buys Nigerian stocks. So the Nigerians give the Americans information, but they don't give us. So any information you want, you can find it in American stocks. So you want to do your research and see, ask yourself a question. Will people buy properties or people rent properties and all that kind of stuff? That's what you want to find out. Then where should you invest? That's basically, I'm just giving you an example of how I invest, how I approach investment. It's not complicated. It's putting money aside.
Thank you so much.
Hey, you're welcome, bro. All right, so we're back to DM. Sorry, guys. Just want to make sure I clear my DM, folks. Someone is talking about Central Bank of Nigeria wants to introduce a new redenomination policy. That's for Oga Wilson to answer. Are they going to change the Naira to do redenomination? I mean, they can. They can, but that's just going to be a new Naira thing. One thing I tweeted it last week, one thing that affects the Naira is this constant news. The CBN governor is in the news, Naira is in the news, there's policy, there's secular, too much activity, just things are happening. CBN should just go on a news blackout, for like a year. Don't talk, don't just give your normal usual seculars for the market, monetary policy, but just less of we will do this, we have arrested Olam, we want to arrest you, we want to chase you, you can't do this with dollar. There's just too much news or too much threats, too much things will happen in the economy that people just don't feel comfortable bringing Naira through the official channel because you don't know what's going to happen tomorrow. You do this, you do that. You've arrested one of the largest commodity traders in Nigeria. The Secret Service is arresting them, not police, not EFCC, Secret Service. Why is the DSS investigating an economic player? Secret Service. Same way Secret Service is arresting the central bank governor. All these things show up on Bloomberg. So you go to Bloomberg, the 22-year-old boy from Kentucky that is managing $200 billion for one pension fund wants to buy bonds to spread his risk. And he goes to Nigeria. He sees the central bank governor has been arrested by the FBI. He will go to Ghana. Ghana is not doing as better as Nigeria, but you don't hear all this news from Ghana or from South Africa. They're not doing better than us, but they sort of keep things civil. The Secret Service should not even be seen in the news. Why are they arresting Central Bank Governor or Ola? What we want to do, I heard them arresting Taylor. They will arrest Taylor, they will arrest CBN Governor. Same Secret Service. Okay, let's go to serious stuff. Carl, just to be clear, are you advising that we should take Naira and invest in US dollar investments? So I'm not advising, I'm giving an opinion. The one opinion I can give you for free is that you must be diversified. You have to diversify your country risk, you have to diversify your currency risk. And when I was growing up, we didn't have ways to diversify country and currency. There were no apps when I was younger to invest in the US. None. Right now, if you live in Aba, it's possible to buy Tesla stock from Aba. It wasn't there years ago. So you want to take advantage of that. You want to spread out your risks. But remember, if you simply hold dollar in your pocket, you're not making any returns. It's just paper in your pocket. But if you invest in a dollar denominated asset that is paying you dividend, that's going to be a way not just to diversify, but to earn a return. That's what I'm saying. And you can take that to the bank. Hey, Oluwa Pelumi, how you doing, sir? Where are you calling from?
All right. Good evening. Good evening, everybody. I'm calling from Nigeria.
What's up, bro?
From Lagos, precisely.
What's up? Go ahead, sir.
I say I'm calling from Lagos.
Yes.
Lagos, Nigeria.
Go ahead.
All right. Thank you very much. The topic, I'm so sorry I joined late, so I really don't know what has been discussed earlier. But I'm just so interested about the retirement savings aspect and investment. Because I'm also an expert in that aspect. So just to understand how it works in different countries. So Nigeria doesn't really have a unique system because we are running what's called contributory pension scheme. So it's more like instead of the previous one, which is defined by the employer, now it's based on contribution from the employee. Then the other part is being done. So everything's always been managed in bonds, in other trading investment fund like that, which the retirees or the contributors doesn't really have any say on. That's the reason why they have a pension fund administrator. But on the aspect of the retirement benefit payment, that is where most times in Nigeria, most particularly, that has caused a lot of problem, a lot of dilemma, even a lot of issues to some retirees understanding what is about the retirement, because a lot of retirees believe that the mode of retirement contribution is as if it were to be the same of me withdrawing my retirement benefits, and that's when it is different from US or Canada or other Nigeria, most times in general. So in Nigeria system, we have two modes anyway by the law. So the law says that you can go for either program withdrawal or annuity. Now, the two have their own advantages and disadvantages. Basically, on the aspect of the program withdrawal, one thing about the program withdrawal is it is limited. It has a time ban. So what it simply means that while you have been programmed for based on the estimated number of years, that is based on what is called the life expectancy believed that someone should live. So when you reach that, let's say you reach the life expectancy being calculated for an individual, a retiree, by the time you reach that time, your pension will have exhausted. So you are only going to fall back to either you are falling back to your personal investment or you are waiting for the government to pay you what is called minimum pension guarantee. Now the issue on that minimum pension guarantee is that one has not even been effective in Nigeria present. It's just like a normal social welfare system that the government will not take on. So that's of doubt. So most times a lot of retirees believe that the program withdrawal, they are investing in my fund, there's a return on it, there's a high return on some. Now the issue on that investment is that it's not something that is directly effective on retirees' income, because before you invested it has to be maybe around 2 years, 3 years they do what's called enhancement. So most times a lot of retirees you have to wait about 3 years before you even believe that you have any effect on whatever profit that has been made on your investment. And by the time you reach that maximum program number of years, your pension will have exhausted. So technically, you are not entitled to any pension anymore. So except you are qualified for what's called minimum pension guarantee.
Say that again. Say that again.
So the other aspect, which is always common everywhere, it's common in US and Canada, Asia, is called the annuity. Basically, the life annuity. That's another system we run in Nigeria. And that one simply is run by most time by insurance company, life insurance company. It's a means of risk management. So you come to the pool of retirees fund. Your fund is invested in pool. Now the guarantee is that a calculated value is given to you, and that value is what is going to be paid for that retiree for as long as he or she lives. Now, it has a guarantee period of 10 years, which is the principle that within the 10 years, if there's a death of that retiree, that the remaining balance should be paid to the beneficiary. But after 10 years, if there's no death, and the retiree leaves, of course, the retiree will continue to be enjoying his or her pension, because that risk of longevity has now been transferred to a life office, which means that even if I live another 50 years, I'm guaranteed an income for life. So, but most times the disadvantage and advantage of both sides is that program withdrawal, okay, yes, there's what's called the uproar, or what we call the enhancement system. That is the term.
Okay, so
that, okay, if I'm collecting 20,000 naira, the possibility that in the next 3 years I can be increased to maybe 22 or 25,000 naira, taking away of the inflation aspect. But by the time it got to maximum program number of years, that one will also exhaust. Now the other
hold up.
I need to tell you that okay, they're paying you 25,000 naira.
Hold up.
Yes.
Just want to make sure you're not. If you just keep on going on, people might not follow. You're getting a lot of information, but if you just go on, well, I'm gonna follow. I'm gonna lose people. I think it's yeah. Do you have a specific place you'd like to focus on, so that way we can actually I think you've clearly given us a great summary of the system. So Nigeria is defined contributory, which means our contributions are defined. In the past, we had defined benefits, which means benefits were defined. We can't afford it. The whole world, no one can afford defined benefits as it is in the whole world. So we're all going to contribute. Did you have any specific place you want us to focus on, or you had so that way we can just follow together?
All right. Okay. So perhaps we can focus on the investment retirement after official retirement. So let's I think that will be okay. So we can understand to helping people that have retired and how they can be able to sustain their retirement age, to guarantee them that even if the kind of investment they can do, and also how they can be able to guarantee income for as long as they live after retirement.
Which is just the annuities, right? For now.
Yes.
Okay.
Yes.
So, but I mean, in Nigeria is a very, very unique place. So I would say this, right? In the US, people work in, say, New York, California, big cities, and when they retire, they change location from, say, New York to Florida or, say, Tennessee, because it's cheaper. So they sell their home, they downsize to a different state. We don't do that in Nigeria. In Nigeria, someone comes to Lagos from, say, Abia State, right? And he buys a house in Lekki. And when he retires, he still stays in Lekki. So the property, or should we say the cost of his retirement, doesn't really change. The housing stock doesn't change because those homes are occupied, even though he doesn't have kids in it. But I would say the most important retirement plan I would tell anyone is to own your own home. Simply because the cost of rent in Nigeria is very expensive. If you are able to take away the cost of rent or mortgage, that's one of the best retirement you can have. And again, if you own your own home and you leave the city, you can always rent out your home, and that's income to you. And it's really the yield might not beat inflation, but it's cash in your pocket. So if you have a home in Lekki you build for whatever millions, and you move to your village, rent the house out in Lekki, it's cash to your pocket, it sustains you, and you're not paying any rental. So that's to me one of the best ways, i.e. not to make money, but to reduce expenses. That's how I would put in advice everyone. So that's why I like real estate in Nigeria. It's not going to make you a yield, but it's going to save you expenses down the line.
All right. Yeah. I think one of the issues with Nigeria, because to be frank, really we see most time, let's say public service sectors, maybe few people that will be able to have enough cash at once. And the mortgage system is too high. The interest rate is too high.
We don't have a mortgage in Nigeria. Nigeria doesn't have a mortgage system. So, I mean, the way people build homes in Nigeria is over time. You buy land in one swamp, then over 20 years you build a house. That's the way people have done it. I know drivers in Lagos that have landlords. You buy the land, 1 year you build one fence, to 1 year you build foundation. You take a long time to build that home. If you wait for a mortgage, or you wait for NHF, or you wait for any of these schemes, you're not going to have a house in Nigeria. Only a few, very tiny minority can go to the bank, get a loan of 100 million, or buy a built home and live in it. That's just a very, very few percent of Nigerians. The bulk of Nigerian working class own homes from buying off plan, private off plan, and building over the years. That's just it. So if you're young, that's going to be one of your targets, becoming a landlord, or just cutting away that expense. Even if you're not going to live there, start to buy land, start to build a house. Even if you're not going to live there, if your income does expand, you can always sell that property or go buy something else. But at least you know you have something that's going to reduce your income. Very important. Very important.
Another thing I would just suggest to add to that is, perhaps, like, I think the saving culture in Nigeria is not most times people, if you have 5 naira, it's an ideology of spending that 5 naira instead of taking at least 1 naira of that 5 naira, keep it somewhere. Before you know it, most times it's inflation, all this kind of thing. But what I have discovered about this inflation in Nigeria, yes, it's not something that anybody can per se have any say on it. But nonetheless, that value of what you desire to use it for will still be there. Because why? By the time you get, let's say, you save one naira, and before you know it, becomes five naira in the next, let's say, 2 years or so. That 5 naira will be something that you will use to buy something or use it for something. Yes.
You're right.
So I think most time, yes.
Yeah, you're right.
So most time, I would just generally say that for retirement, it's better to have additional, maybe savings plan somewhere that will be able to cater for end of it. Because as you are saying now, do you know that it takes time, most time, for public sector in Nigeria to even get their pension? If I retire now, I have to wait about a year before my pension is available for me.
No longer. That if you work for the RSA, if you are with the PFAs, you don't wait for a year. It's almost instantaneously.
It's the same, sir.
No, it's not the same. It's not the same. What you're talking about is, if you have money with the RSA, with the PFAs, they have to get money from the federal government to add to your RSA and pay you. That's what delays. But the money you have with the PFAs, it's yours. You can go into the PFAs, present the document that you have, and you can get 25%, or your money's in that PFA. The delay is that the federal government has got to fund your pension from when you started to work till 2004. That's the fund that you are talking about that takes a year, because it's budgeted. Yes. But the money with the RSA...
But the issue with the law presently is that the law ban that if let's say I retire after 50 years and that fund is not yet funded, so the law does not allow me to access my pension until all accrued rights is paid. So that's why most times you see a lot of retirees, I retire now. Most of the retirees, I have to wait about some month, even a year, before I get my pension.
Yeah,
and it's even worse for states.
Just wanted to clarify that it's really that the federal government has not funded, not because the PFA is not paying. If you have additional voluntary contributions to the PFA, you can take it out even without your funds being there. So if you have AVC, you can take that out after 5 years, irrespective of whatever funding is happening. That is a separate one. Is the total pension, which is your past pension under defined contribution benefit, plus the defined that is held up because the federal government has not paid. States are a different kettle of fish. States are not legally under the retirement savings account, so they only do it on a voluntary basis, and you have to read your state's pension act. That's what they go with, not the Pension Reform Act. So if your state says you cannot get money till X happens, that's what happens. States don't go under the federal pension scheme. Yeah, so make sure you read your state's law before you retire. Very important. My brother, thanks.
Thank you very much.
You're welcome.
No, I agree with that. I wanted to add a few things, but it's okay. Yes.
Yeah, sure, super. Let me just rotate the room, right? Because guys, we're talking about investment savings, US, Canada, Nigeria, just how you can, change out your mindset. I think the main thing here is mindset. I think Mr. Oluwapelumi touched on that. When you go abroad, remember savings work abroad. In Nigeria, because of the high inflation, you could say that yes, if I save for 10 years, inflation eats everything, so I don't save. But when you are abroad, savings work. So you have to have as a habit that when you make your paycheck, you want to save it. Inflation won't eat it. So that's one habit that we don't take when we travel. We go over to America, we want to buy everything with our savings. No, you buy over there they buy with credit, right? And we don't save. We want to, do the Nigerian mindset over there. So pension savings are how you fund your retirement. If you want to buy a house, you do a mortgage because you get the assets early, then you can pay off that asset down the line. If the asset appreciates in value, that appreciation is yours. So you want to take advantage of that credit and long-term fund that the West does gives you. In the Nigeria, I get it. It's not hard to save, but if you're going to go to the West, mindset has got to change. You can't buy stuff with your own cash and all that if there's credit available, because your credit score is the most important number that you have or that you need over there. Udechi, let me have you come in, sir. I've got Udochi Philip. How are you, sir? Mr. Philip, go ahead. Mr. Philip?
Thank you very much, Kalu. Can you hear me?
I can.
Yes, sorry, my network has been flipping.
Sorry about that.
Thank you so much. Thank you. This topic is a tricky one because I'm hearing a little about, of course, when we're on your space, we hear a lot of, you are our plug for those of us that are not economists. You are our plug, and then even though a lot of the terms you use are kind of elitist to us, sometimes we use Google, to break them down. And then today I'm hearing about pensions. The last speaker, hello, can you hear me?
Yes.
Yes. So the last speaker delved into pensions. That thing is, honestly, I'm sure that if you do a survey, over less than 50% of civil servants understand how that thing works. I know there have been a lot of changes, amendments have been made. I can't remember the most recent one. I know that if you don't get to a certain age, you cannot access, as a civil servant, you cannot access your funds. And I know that there's also a new amendment that you can get 25% of what you have saved. If there's a condition, if it's going to be used to acquire a piece of land, I guess, buy a property or something. I'm not very sure, but I would really appreciate if you could start like moving in that direction. I believe this is what a lot of people want to hear and understand. Maybe in collaboration with the last speaker, I just craving your indulgence that maybe for subsequent spaces you could just help us choose some of these topics that are actually pertinent. That given that we have agencies of government that are supposed to educate the public on some of this. We have a national orientation agency. This is public space. I wouldn't want to rate them here, but I believe there are certain institutions or entities of government that are supposed to, complement these things that we do here, but from a public sector standpoint. I don't know if you understand what I'm driving at. Yeah. So, pension administration is a big topic. A lot of civil servants have no idea. It's contributory now, so you contribute, and of course, the fact that it's contributory means that if you earn higher, what you're going to get at the end of when you are due for it will be much higher than someone who earns less, because it's actually tied to what you earn. So, which is also another challenge. Again, there's the issue of choosing your PFA. will not mention names, but I know two persons are using two different PFAs. The difference in their contributions to date is 4.5 million, almost 5 million. Same salary, same grade level, but the difference, because one of the PFAs has probably invested, is a better investor, or has better put their that particular the person's savings, in better investments. So imagine almost 5 million difference. Same salary, same contributions, but different returns like PFA. So
I got you.
You got that right.
Yeah, I mean, I hear you. So I think for pensions, if you look at we've done, I would say, a lot. We've brought the Association of Pension Fund Operators here, I think 3 times. We've done mortgage with pensions, I believe almost 2 or 3 times. We talked about this particular, that you can save with your RSA, retirement savings account, to buy a property in Nigeria. We've done about 2 or 3 iterations of it, right? So we've done a lot to educate Nigerians about using that retirement account. I don't call it a retirement account. It's a tax-free savings. Nigeria is giving you a way that you can save money tax-free for a long period. That's what they've done for you. I want to take advantage of it. It's also a 10% salary increase whenever you open an account. With life cover, 3 times annual monument life cover. That's what they've done. Nigeria has passed that and it's operational. And if your employer doesn't pay, you can report your employer anonymously. PENCOM will go after your employer and force them to pay with all the back interest back to your account. So this is like, it's an employee favored scheme. So you want to take advantage of it. There are lots of things you've talked about, guys not knowing. But you want to go and learn because it's your money. And no matter how many episodes we do, there's still going to be an information gap on it. But again, like you rightly said, you can save now. You can take your money anytime you want. If you lose your job and you don't get a job in 6 months or 3 months, you get 25%. When you retire or you are 50, whichever is later, you get your 50%. The rest is going to be as an annuity to you. And you can also use a part of your funds to pay down a house. I think it's 25% pay down a mortgage. There's a guideline for that. So take advantage, get enrolled. Also, very importantly, informal sector can also enroll into the scheme. In the past, you had to have an RC number to register into the scheme. Right now, as an individual, if you want to enroll yourself, you can. You go to, there are lots of informal registered guys, and you basically enroll yourself into the scheme. You make your own contributions in and all that. So the idea is to have this pool of funds that will give you that protection as well, that tax protection, that anything you contribute there, you don't pay, you defer taxes on it. So take advantage, guys. Nigeria is not everything that is bad. Many things are going on good. This scheme, I consider the pension scheme in Nigeria one of the best examples of PPP in all of Africa. Before we did this scheme in Nigeria owed 25% of her GDP. 25% of GDP was the pension deficit in Nigeria in 2003. If you remember how old you guys are, if you go back to Ikoyi in those days, you see army guys, military guys sleeping in Ikoyi waiting for their pensions. That was the situation we were back then. We couldn't sell anything because NITEL, Nigerian Ports, Airways, all had pensions. Today, we are nearly at $1 trillion or so in assets run by the private sector, funded by the government and private sector, biometrics created in your name, investing in funds that track you from retiree to when you join, i.e. you are an equity-looking guy, right? That's what we've done. Nigeria has done it. We used the Chilean scheme and we adopted it to our own model. And in many aspects, what we have in Nigeria under a defined contribution scheme is what the US is even trying to copy. When George Bush was talking about privatizing social security, this is what he was talking about, what Nigeria has done. And I know lots of African countries come to PENCOM and try to copy what PENCOM has done. So it's a big, big, big positive Nigeria has done. We now have long-term assets in Nigeria. If we need 100 billion long-term, 25 years in Nigeria, we have it because we have the pension reform act. So congrats to Fola Diola. I think he was one, and together with Chinelo, they are the ones that did that ran the whole scheme and get it up to scratch. And Pencom has done a good job to keep it up to date. So good job, everyone.
Thank you, Carlo.
You're welcome, man.
Thank you so much.
No worries.
Thank you too for responding to my DMs.
No worries. You're good. All right. I got Iconet Enterprises, a company or a name? Iconet, you've got the floor before I go back to DMs, which I love to read. Iconet, go ahead, sir.
All right. Good day. Thank you so much for the opportunity. I think I sent you a DM also. All right. A quick question. I think I heard a few people ask different things, but mine is related to one of the participants must have asked. For example, I am trying to use so far so good, let's say for let's say not in the civil service or anything of sort, but sole and proprietors trying to do something for themselves. And currently in the banking sector here, the interest rates are kind of quite funny, but I try to use something like PiggyVest, one of these fintech companies that try to pay a certain percent. At least it reads something that shows progress. But there is still much to be done. For example, I heard about how one can be able to diversify income from here, Nigeria, buying stocks in the US. So I really want to know more about how it works and how to really go about it.
Well, first thing, if your question, you want to invest abroad. You're already investing in Naira, right?
Yes, of course.
Nice. Okay, I mean, why are we investing abroad? Why are we saying you should diversify? If you can, I'm going to mute you just so I can have, yeah. So the reason why we're asking you to diversify just because it makes sense on a financial planning level to diversify income, currency that you're holding. So that's just good advice all the time to diversify. How the Nigerian Security and Exchange Commission has licensed certain apps that you can use to then invest both local and foreign stocks. I think I've quoted them before. Chaka. I mean, I'm going to post them up. So I'm going to post it up on the timeline so you can go and look at it. Just look on my DM. So there's Chaka. Chaka is licensed by SEC. Chaka. Yes, Chaka stocks. I put it up there. There's also Cowrywise. Cowrywise is also licensed by SEC. I think Bamboo is licensed, right, guys? Bamboo is licensed. Which other one? There's one more. There is what's the last one? There's one more. Shaka, Cowrywise, Bamboo. Who else? I'm missing someone. Jeez. Okay, sorry. So I posted the three that I know. If you open an account with these three guys, you are able to buy stocks abroad, or buy bonds abroad, or buy ETFs abroad. And so you're buying it with Naira. So it's a good way for you to diversify, right? You're taking your own local currency then to invest abroad. That's basically what it is. So, but the point again I'll make with you is that savings and investing is a habit, right? The more you do it, then the better you get at it, right? So you want to make sure that you learn that habit to put aside something and then be able to invest today, because tomorrow you can then take that delayed consumption and it should have earned more for you in terms of interest, and then of course you can run with it. So good job if you are investing. I appreciate that. Please bring me to it. There's a guy here on Twitter, DM, final year pharmacy student, and I can't nail down financial discipline. So this is very important for you to learn, sir. If you don't learn how to save 1,000, it's very, very difficult to learn how to save 1,000,000. And most times when I ask people to save, it's because I want you to get the habit. Not the interest per se, but the habit. The habit of spending less than you make. To get wealthy is a very, very simple formula. Very, very simple formula. You have to earn money. Then whatever you do, you want to spend less than you make. Then you invest the surplus and you simply repeat, rinse and repeat. You earn, you save, you earn, you save. Where you save is a different topic, but you earn and you save and you simply rinse and repeat. The more you do it, the more it becomes a habit, then the more you can have funds that you have delayed to consume available for you. And you have to learn this at the university or even at the secondary school level. So it's not it's just you have to do it. Join a Susu group and save with your friends. So you guys are responsibility partners. So you can get 4 of you. Say you want to save 100 naira and save. It builds discipline for you, right? You don't say I don't have money so I can't save. That's already a ridiculous attitude, because even when you have money, you're not going to save. I get it. It's the hardest thing to do is to save, but it's discipline. If you don't get that discipline, you can never ever invest. And don't think me talking to you, I'm the worst saver on earth. The way I save is I don't even see my money. So I set up automatic debits from my paycheck and my investments. So my investments go automatically from my paycheck to investment, because I know myself. If I have that money in my hand, I'm going to Greece for holidays. So I remove that temptation myself. I take it off from myself. You keep your credit cards low, do your investments direct deposits, and do automatic investments. So that way, if you are tempted to save, you are removing the temptations around you to spend money. If you don't fix your money, it's difficult to fix other stuff. And if you can't do it, then try to restrict how you see your cash. Direct deposits, automatic savings, very, very good, right? So my friend Cube, try to do it. It's a discipline thing, right? It's not yet investment things. Try to do it. I have a book, bro. If you can get the book and you can read it, I wrote this for people like you. Explain in simple language how you can go from point A to point B. What are stocks? What are bonds? How should you invest? How should you do asset allocation? If you can afford it, try to get it on Amazon. Yeah, try to do it on YouTube. If you can't afford it, send me a DM. Yeah, just you. We'll talk about it. All right. Mercy, go ahead. Mercy, is that Mercy Tim? Hey guys, we're going to round out top of the hour. We're going to call the date of the hour. So we've got about 30 minutes left. Mercy on the floor. You're going once. Vinicius Senior, Engineer CJ Vincent. How you doing, sir?
Yeah, I'm doing
Vincent, your audio is not that good, bro.
Okay, is it better?
Yes, it is. Go ahead.
Okay. Thank you so much for this space. I've really learned a lot. I actually am I do some investing currently, and still a lot of things that people have spoken about here. I've still been able to learn, gain some more knowledge. So I just want to, I noticed that some people do not have knowledge of some platforms or applications that they can take advantage of, in these times. And aside investing in the US, like through these platforms that you mentioned, Shaka, Bamboo, there are also some companies that can help people to invest even in the Nigerian market. If you do not want to go and buy individual stocks, like maybe going to buy MTN for yourself or any of these listed companies, and they are insured because they are owned by companies that are like institutions that are ingrained in the Nigerian system. One of them that I use is United Capital's investment platform. Is called Invest Now. And United Capital is like the investment arm of UBA, so you can be sure that your money is safe. And then, like you mentioned now, you can have this automatic saving, so that your money is it can help your investing culture to automate it. So they also have this kind of features, and they return quite a good interest per annum.
All right, I got you.
Current.
I hear you.
Yes, and there's some other ones to FBM Quest and the likes. Yes, so the reason I'm speaking more on the investment as retirement is good, and all it's good that you have something saved up later for when you're feeble and you cannot do much for yourself, and it's good that you have something coming in. But because of the time value of money and this inflation and the rest, I would rather people not rather actually, you can do both simultaneously, but you can focus more on investing. Like now, remember how you were speaking about real estate and how the income is more, and the time, the range where you can expect an income is not very long like that. It's the same way with this one. So you can invest in applications like this, as against maybe putting your money in a savings account, whereas you know that now most of the banks don't even return much interest, and then the interest of these ones can make up for the inflation, and then people can. I will just to bring this to people's knowledge, anyways, so people can still do their own fact finding and learn more about platforms that they can take advantage of, so that you can have savings, and then you can.
I hear you. But quick question.
Also have easy access to your money. Yeah.
I hear you. So let me just say something, right? People always use the word savings and investment, right? And they use it interchangeably. So is there a difference between savings and investing?
Yes, there is a difference. Savings would be that you are not expecting an interest, you're not expecting income on your money. You are just keeping funds for a rainy day, money that maybe if you had it in your pocket, you would have spent, and then you save it so that next month, where you might need it, you have access to it. Investment would be that you are putting the money somewhere that you can have a return, maybe in a property that you know that in another year or two, the value of that property would have increased, or you are giving it, to a company that would invest it, put it in businesses and other investments, and then it return the percentage of, the profits, the gains that they make. So I believe that would be the difference.
Yeah, I mean, great. I mean, like you said, when you are saving, you are not consuming. Easy. When you save, it simply means you're not consuming. If you earn 10 naira and you put it in your pocket, you saved it. It could be you just don't want to spend it today, or you just don't know what to spend it on. So you are saving. There's no thought process. There is no expectation of returns, more or less, right? But when we invest, we are doing something pre-planned. We have an expectation of future returns. We are looking at risks, and that's just the key difference, right? So I would say the most important investment objective for everybody is your retirement. Why? Because as you get older, the opportunity to save for retirement vanishes. You have a limited time to live. So you have a limited time to work. Your working life is fixed, more or less, right? And also the way investment returns are calculated is over time. If you look at the calculation for present and future value, it is raised over time. So the longer your investments are, the more you make. So I think, was it you or the guy that just called now mentioned about two folks with PFA balances that were different? If you earn the same amount of money and you save the same amount of money in the PFA, but your friend starts to save earlier than you, your friend will have more money than you, simply because his investments are compounding more than you. I mean, if you want to take it further, and I'm going to share an infographic on Twitter, right? If you start to save 10 years before your brother, and your brother saves double the amount of income that you save and double the amount of time that you have saved, if you save earlier than your brother, you will have more money than him, because compound interest works with time, not with how much you save. So very important point, that whilst you are saving, you want to make sure that you are saving early. You start this whole investment thing early. You don't wait till you have money before you save. You start to save as soon as you have income, not when you have quote unquote enough income. Yeah, very important point. And let us go back to DM real quick. Someone is asking, could you please explain the Roth IRA? Yes, it's R-O, not R-U, R-O-T-H. Roth simply is the name of the person that introduced the bill that got this passed. So you're asking me to explain the Roth IRA and its difference. So the IRA is the individual retirement account, and it is different from the 401k, which is by your company. So with the IRA, it's you want to save money yourself. So US law allows you to save this year $6,500 maximum in your Roth IRA, according to an income cap. So if you make above a certain income cap, you cannot have an IRA. It's only for folks that make below a certain income cap, right? So when you have the Roth, for instance, you put in money into the Roth, you are going to pay taxes when you put it in. What does that mean? When you put in money into a retirement account, normally you deduct that contribution from your taxes. But with a Roth, you don't deduct it. You're going to put in the full amount because you are paying the taxes. So you get taxed when you put it in. After you put the money into your Roth, after 5 years, you are free to deduct the funds in your Roth without you paying a tax, because you already paid a tax 5 years ago. So it's a very, very good way, number one, for you to save. Number two, for your contributions to grow tax deferred, which means it's going to grow without you paying taxes and compound without interruption. And number three, you can take it out at any time. In America, you can take out your money only when you are 59 and a half without paying a penalty. But with a Roth, after 5 years, you can take it out. So you can see the advantages for you. If you have funds in your Roth, and the funds in your Roth or the assets in your Roth grow in value, you no longer pay any tax because you put it in there and you already paid the taxes. So that's just the key difference between the Roth, R-O-T-H IRA, and the traditional IRA. With the traditional IRA, you pay taxes when you take it out, not when you put it in. But the assets will still grow tax deferred. So that's just the key difference between those two. All right, Mercy, hi, welcome back. Do you want to speak now?
Yes, thank you, Carlo. Thank you for this beautiful platform. So I'm just going to touch base on some of the policy on pension and annuity, right? So I heard one of the speakers that spoke to program withdrawal being time-based, but I would say that is not completely true, in the sense that, when you're about to retire, you have two options. You have to pick program withdrawal or to pick annuity. And when it comes to program withdrawal, when they are calculating your template, which is the agreement at retirement, what they are putting on your template is based on the current balance. They didn't factor your return on investment on what is on your template. So what they were saying is, with this XX amount that you have currently, it can last you for like 12 years. It can last you for like 18 years, right? So, but with the advent of return on investment, program withdrawal is for life. So let's take, for instance, someone that has as little as 5 million cannot exhaust that balance because of return on investment. I work in one of the leading PFAs in Nigeria, so I know this. And I've been able to assist people to actually process their program withdrawal, and I manage retirees as well. So I know the similarities and the difference between the two properly. So and also for my firm, we have an insurance arm as well that deals in annuity. So we have vast information about these two programs. So and with annuity is for life as well, and then you have something called guaranteed period. So what guaranteed period tends to do for you is, if the contributor outlive the guaranteed period, your beneficiary gets nothing at the end of the day. Meanwhile, and also with annuity, once you sign up with annuity, you can come back to program withdrawal. Then you don't have access to your statement anymore. Meanwhile, with program withdrawal, as you are being paid, you have access to your statement. You can see what is actually remaining in your balance. And for some of my retirees that have been receiving their pension for like 6-10 years, they come back with testimony saying at the point of when they take their lump sum and their monthly payment, they can categorically say the difference between the amounts back then and now is minimal. Because the advent of return on investment, they were able to sustain paying them for life. And then now you will say that your balance finished. There's something called guaranteed pension payment. And the guaranteed pension payment is life, apparently. The only thing that the contributor has to do is to visit the PFA on a monthly basis to confirm that he's alive, so that they don't go on paying you while the contributor has passed on. So that's what the contributor has to do. So let's say your pension balance finished, you are meant to collect pension for life. And for people that have, let me say, after the calculation of their templates, we were unable to successfully pay you 10,000 naira in a month. Then they are meant to collect en bloc. That is, they'll pay you everything in your pension account, and then the account goes into dormant until you get another job. Then you can start contributing again.
I got you. So again, lots of folks are telling me on the DM that they don't understand the terminologies. So that's why I want you guys to break it in bit sizes so people can follow. But I think the point I wanted to get from you was, you are saying the annuities are for life. Is that correct? So if you get an annuity from an insurance company, it's for life.
Both program withdrawal and annuity are for life.
So both program withdrawal and so that means that if I retire and I buy, I'm going to be paid for life. What if my funds can't pay the life? I know they can reject me if I don't have up to a certain amount, correct?
Yes.
Okay.
So that's why I mentioned that at the point of retirement, when we do the calculation of your agreement, and it's showing that we cannot successfully pay you 10,000 naira in a month as a monthly payment, then we are to pay you en bloc, that is, pay you everything in your balance.
Gotcha.
But once we are able to successfully pay you the 10,000 naira, even if your balance finish, we are PENCO mandates it that we set aside certain amounts from our profits year on year to actually cater for whoever that their balance has actually finished. We have clients that are actually on that payment as we speak. So it is life, and once you retire and then you qualify for program withdrawal, you're on pension for life.
I got you. And then the other point again you made is that my beneficiary, if I'm paying for life, can I specify I want a beneficiary? Is it automatic that if the person passes away, the beneficiary takes the balance on both program withdrawal and the annuity? Is it automatic?
No, so with program withdrawal, it's not automatic. With annuity, it is. Okay. So with annuity, there's a part on the form that you can actually state who you want the insurance company to actually pay the balance to. Okay. But when it comes to program withdrawal, you have to. We only honor two legal documents. It's either you have a will or your beneficiary will obtain something called letter of administration from the courts. Okay. So that is what we actually honor. So, and the reason for this is to avoid legal matter with family members, because at the point of registration, some people will put their brother, their pastor, their friend as next of kin, And with next of kin is just someone that we can call in case you're not available. And then at that point, some people forget to even update their accounts. So that's why we can't go on to use next of kin as a beneficiary. That's why we have to go with when the contributor passed on, it's either the contributor has a will or the beneficiary gets a letter of administration from the courts to say is the legal person to actually withdraw the balance.
All right, so in essence, what you're saying is that when we do our pension and paperwork, the next of kin is not that material. What you're going to go with is a letter of administration or the will.
Exactly.
So will is it like if I just bring a will, or is it a probate will, or
yeah, it's actually
probate will. Okay. Good information there. Good information. Yeah, thanks a lot, Mercy. Thanks for giving us that insight.
That's the number one. And then number two thing that I would like to speak about is the 25% temporary withdrawal. So when it comes to 25% temporary withdrawal, it doesn't have to do with age. So, and the minimum age of signing up for pension is 18 years. So once you are 18 years, if you work for like 6 months or 1 year, and then you feel like leaving the employment, you can actually take 25% of your pension balance after 4 months of inability to get another job. So the only one that has to speak with age bracket is the one that speaks to retirement, because assumed age of retirement in Nigeria is 50 years with pension. So once you're 50 and you feel you want to resign or you want to leave your job, then we profile you as a retiree. Whereby we pay you lump sum and we start paying you on monthly basis.
Okay, so
but when it comes to temporary payment of 25%, age is not a factor.
Okay, and how long do I have to be out of work to get that? How long?
So for the temporary access, which is the 25%, there is a 4 months waiting period.
4 months.
But
okay.
When it comes to the one that you have clocked 50, whether you are disengaged or you voluntarily resign or voluntarily retire, you don't have to wait any day to come to us to say you want to access your pension fund.
Gotcha. Okay, super. Makes sense. All right. Excellent. Thanks for all that. That was a lot, but thanks for breaking it all down for us. Appreciate that. And all right, just hang in there. I have a question for you. There's a guy on that wants to ask you a question. Let me just see if I can read it out. What's the difference between a savings IRA and investing IRA? There's not like a savings IRA. They are both. Your IRAs are all for investing. It's just going to be if it's a Roth, ROTH IRA, and if it's for traditional IRA. And they are both in the US only. So you can do a Roth IRA or traditional IRA. The difference is that Roth IRA, you pay taxes when you invest. With traditional, you pay taxes when you take it out. So that's just going to be the two difference. Yeah. Okay, and compounding. So guys, remember, compounding is a verb. There is no investment that's, let me put it this way, you have to do something to compound. Compound simply means you are investing the interest back to the principal, and then investing the principal plus the interest. So if in some stocks, right, you have what's called a dividend reinvestment plan. In the US, they have it, so you can buy a stock and tell them automatically to reinvest your dividends. So when they do that, right, you are compounding because they give you a dividend. It goes automatically back to the principal, and then you can compound, right? But if they don't do that automatically for you, the way you compound is to take your physical dividends, pay it back into that same security to buy that same investment. So that way you are compounding your returns by reinvesting interest on interest, and then you are making it invest for you. If you think, you can't simply say stocks compound. If you take your dividends and you spend it outside, then the stock itself is not compounding. The whole idea of it compounding is that it's going into the investment, interest on interest. Hope that makes sense, guys. Okay. I've got last one, guys. We're going to end. I've got about 15 more minutes. Lot Madden, you got the floor.
Okay, sir. Good evening, sir. Good evening.
Hey, how you doing?
I'm speaking from Nigeria. I saw investing and retrieving 7 US and Canada and Nigeria. So I'm a new in the house, so I wanted to know the real what is mean of things. Maybe you can explain more for me too.
Okay, sure. Do you work in Nigeria?
Yeah, I'm working in Nigeria.
So do you have like a retirement savings account with your PFA?
Actually, I didn't have it because I'm a student. I'm a student. I just finished my distance, so I wanted to know more about it. Maybe it's possible for us to get it.
Yeah. So when you start to work, right, you go to your employer, and then your employer is mandated by law to open an account for you for your retirement. So he will pay 10% of your basic housing and transport to that account. You will pay 8%. Then that money is invested for you. Then whenever you retire, the company then gives you that money. That's what we're talking about. That's what the RSA means. Does that make sense?
Okay, I understand. But if where I'm working is not a company, but I think it's not possible to get this thing visa from here to out direct now. Am I right for that?
No visa, just pensions here. So the law says that if they employ more than 3 people, they have to give you a retirement savings account. And it also says you yourself can invest. So no visa, just pensions. All right. Hope that answers your question.
Sorry, Carlo, I would like to buttress what you just mentioned.
Go ahead.
All right. So for people that maybe they have their own business, or you're an employee in an informal sector, right, where the pension, contribution pension scheme policy is not, in which they are actually not doing pension, you can actually subscribe to micro pension, right? So micro pension gives you the opportunity to do pension for yourself. Let's say for instance, after a student right now, maybe you have a little business in the school running. So far you are 18 years, and then you have a business for yourself, as little as it can be. You can actually open a micro pension account for yourself, whereby you put as little as 1,000 naira, any amount into the account. And then that you can do it any day, anytime, weekly, monthly, daily. You can just like a job. Or it's also what they call it. Right. So what micro pension opportunity gives you is any amount that you contribute, you're going to split it into 2. 60% will go to your retirement, while 40% goes to your contingency account. So what that contingency account means is we know that people that have their own business will always need money for one thing or the other. So that particular 40% you can withdraw it once every week.
All right.
Why?
So I don't want you to flood him with it. I don't want to flood him with so much information. He's really at the very he's a student, right? So what I would say is this, right? Really focus on your studies for now. But what you should take away from this is that once you retire, you want to have a pension account, my brother, right? That's what you want to focus on. Just get a pension account once you retire and start to contribute. Yeah, that's one to get from this, right? All right, guys. Thanks so much. Yeah, super.
Okay, thank you very much.
You're welcome. So I have a few DMs before we end. Just end with DMs. Someone is asking me, I work, how else can I build my credit card apart from credit? How can I build my credit score apart from credit cards? I'm in Canada. So you want to Google this word, secured credit. Secured credit. So you want to go to your bank. Usually you might have credit unions or banks that offer this. So you want to go to a bank and ask them, do you offer secured credit? Or just Google online to banks that offer secured credit, right? What it means is this. You're going to give them your cash and they're going to give you a credit product. That's essentially what it means. You give them your cash, they give you a credit product, and then they are able to basically buy you. When you use that credit product, it reports to the credit bureau, and then you get a credit score. It can be a secured credit card. It could be a secured personal loan. It doesn't have to be much. $500 secured credit. Take it for a year or 2 years. Make the payments back. As long as you're making your payments on time, it's going to reflect in the credit bureau, and it helps you to build out a score that when they pull your FICO, you then get it. So that word secured credit is how you can basically get other ways to build your credit apart from credit card. It could be a secured personal loan, my brother. So I didn't say run and do that, right? And also, private sector can't access immediately, but no, everybody can access pension retirements in Nigeria once you retire. So once you retire, you go to your pension fund administrator, ask for documentation, give it to them, and you can get your pension out. If you made an additional voluntary contribution, you can get it immediately. If you are the public sector, they usually have to wait for the government to credit your account with your accrued benefits before they pay that to you. That's usually where sometimes you get a delay, but you get it. No, like you heard the gentleman say, no age limit. Just get your paperwork. It's 50 years or whenever you retire, whichever comes later. That's when you get it. Now, let me just say the last question, guys, is going to be guys asking for if he lives in Nigeria, but he earns dollars, and he wants to know what he should do. How should he invest? So I work remotely, I receive FX, I don't need it now, and I want to invest. What should I do? Because DOM accounts don't pay interest. The first thing I'll tell you is that if you earn in a currency, it's usually advisable to invest in the currency you are spending in, right? So if you are earning in dollars, are you going to invest? Are you spending in Nigeria or in the US? That's the first thing, right? But in this case, you are coming from a high value currency to a low value currency. You want to be careful to maintain the purchasing power of the currency you are earning. Hence, you want to invest in the same high value currency asset class. So in Nigeria, we have money market funds that you can invest in dollars directly. That's what the FCMB were talking about. FCMB Asset Management does have those investments, right? I know FCMB, AfriVest, they have dollar investments. So you can buy a money market in dollars and in a dollar dividend. That keeps your assets in the same US dollar that you had prior. That's going to be one way to maintain that value. Or you could then go into use an app available also in Nigeria to then buy into a bond fund or a market fund outside Nigeria directly into the US market. So you can buy a Nigerian package investment that is offering you in dollars, or you could buy it directly into a US ETF that allows you to invest in dollars as well. That's how you want to do it. I think I posted on my timeline the apps that are approved for you to use. And if you also want to go online yourself, you can just look for those money market funds. If you have a social, it's easier. If you don't, use the apps or go to a Nigerian bank like FCMB and do a dollar investment. All right, guys, almost at the end of it. So we're going to end it now. Thank you so much. We've been about 3 hours talking about investing, trying to relate to essentially to the Canadian, the US, and the Nigerian pension scheme. So the whole idea is to get you into the habit of savings. Like I said, the most important savings you want to do is your pension, your old age savings. Why? Because you have very limited options to compound the older you get. Investment is a game of time. The longer you invest, all things being equal, the longer your compounding can work in your favor. So as you get older, you have limited time to compound, limited time to earn from those compounding returns. So you want to get that done pretty early, which is why we're focusing this week on use savings for retirement. And lots of options. We'll talk about the 401k, the retirement savings account, and of course the Canadian RRSF schemes that allow you to have a tax-deferred means of savings. We'll talk about secondary savings features like the individual retirement account in the US, and also the additional voluntary contributions in Nigeria allow you to do catch-up or supplemental investments also in a tax-deferred manner. You want to avoid paying taxes as you grow your funds because it allows you to compound more. That's the whole idea. Thanks you guys so much for joining in and being with me. Again, we're going to end this. My name is Kalu Aja. I'll see you guys next week when we bring on that topic to do with money, of course, personal finance, and the economy. Last plug, do get my book, Let's Talk About Your Money. It's on Amazon. Well written, well detailed, explains the bulk of all the stuff we've talked about: pensions, investing, asset classes, investing abroad. It will bless you. Thanks again to Amber Students for sponsoring this episode of the podcast and this S Spaces. I'll see you guys next week. You guys have a good day.